Friends, welcome to the channel JIV and CIV Made Simple. If you are preparing for certification examination in foreign exchange or foreign exchange operation, you are at the right place, because in this video we are going to completely revise all the important points related to the syllabus prescribed by IIBF in just 3 hours. So from start to the success, yes, this video will cover the entire thing, right? Because if you go through the questions being asked in the examination, almost 90% of the questions are theoretical type. So I have compiled all the important points and providing you in the form of videos. I am explaining in the layman term possible, so that you can easily understand each and everything. And if you are looking for PDF for such kind of subjects in the form of capsule content, theory PDF, MCQs PDF, there are more than 2000 MCQ previous year question, then you can WhatsApp me on this particular number shown on the screen, or you can enroll in the course. Just in the description section, link is provided. So friends, just buckle up for next 3 hours, listen to every point in the context of international trade, that is called UCP 600, right? So first of all, what is UCP 600? You can think of UCP 600 as the rule book for how bank handle letter of credit in the global trade. Yes, it is a kind of rule book for how bank handle the letter of credit in the global trade. So this rule book was created by the International Chamber of Commerce, right? So International Chamber of Commerce is like global business referee. Now this rule book has 39 articles and it is used in more than 175 countries. It replaced the older version called UCP 500 and it officially come into effect on 1st July 2007. The idea is not new. We are talking in the context of UCP 600. So the idea is not new. It actually started way back in the year 1933, and since then it has been updated many times to keep up with the how trade work today. Now there is something called ISBP. You know what is ISBP? The International Standard Banking Practice. You can think of ISBP as a user guide that explains how to check document under a letter of credit. It makes sure that everyone interprets the rule the same way and clear up any kind of confusion. And now, because the world is moving toward a digital trade, there is an EUCP, which is electronic rule, which are like digital add-on on the main UCP. So these help bank and trader work with electronic document in the same safe and standardized way. So let's quickly revise what we have covered in the first slide. I told you that UCP 600 acts like a rule book for letter of credit in the global trade. It was made by ICC. It has 39 articles. It is used in 175 plus country. And it is the UCP 600 is replaced by UCP 500 on 1st July 2007, and it originated in the year 1933, updated many times. ISBB we talked about, that is the International Standard Banking Practices. So I told you ISBP is the guide for checking document under LC. Then we discuss EUCP. What I told you, electronic UCP. This is the electronic rule for digital trade. Now friends, let's switch our focus to the Incoterms. Incoterms 2000. So something super important in the international trade, so-called Incoterms. The word Incoterm stands for International Commercial Term. Inco means international, IN means international, CO means commercial, in international commercial terms. And it is actually a registered trademark of the International Chamber of Commerce, or ICC for short. So Incoterms stand for International Commercial Term, and this was the first time introduced in the year 1936 to solve a big problem. What was the big problem? That different country had different way of interpreting the trade rule. So this caused confusion, delays and dispute. So ICC stepped in to make one global standard. So Incoterms are written as 3-letter code, like EXW, like FOB, CIF and so on. So it is basically a 3-letter code. Each code tells you exactly who is responsible for what, from paying for transport to covering insurance to taking the risk if something goes wrong during delivery. So the aim is simple: to remove uncertainty and to make sure that everyone is on same page in the international sale contract, right? So that is our main rule. Now actually ICC started working on trade term way back in the year 1923, right? ICC, that is International Chamber of Commerce, started working on the trade term way back in 1923, but the first official Incoterm came out in 1936. Over the time, they have been updated, right? For example, in the 2010 version, the number of terms dropped from 13 to 11. So earlier there were 13 Incoterms, now it is dropped to 11. For example, take the case of EXW. EXW means X work. It means the seller just make the goods available at their location, maybe a factory or the warehouse, and from there the buyer takes care of everything: transport, cost, risk, and the whole lot. So let's quickly revise what we have covered here. So we started with the Incoterms. I told you that Incoterms stand for International Commercial Term, ICC trademark. It was first introduced in the year 1936 to standardize the global trade. Three-letter codes which define responsibility, risk, and cost. Aim is to remove uncertainty in the sales contract. First ICC work on trade term in the year 1923, and officially Incoterms came into start from the year 1936. 2010 it was revised, where terms were reduced from 13 to 11. An example I given you, EXW, which means buyer handle all the cost and risk after pickup. Now let's look at some key Incoterms, where first of all we have delivery responsibility. So let's quickly understand the key Incoterms and what they mean in simple language. Basically, who does what in delivery? First of all, EXW, X work. So this is the easiest job for the seller. They just make the good available at their place, like a factory or warehouse. After that, the buyer does everything, right? Transport, insurance, custom, and you name it. Then what about FCA? FCA is called free carrier abroad. So what is the meaning of free carrier abroad? So here the seller takes the goods to a location that the buyer has chosen, like a shipping terminal or transport hub. From there, the buyer takes over. So that is all about FCA. In short, we call it free carrier. Free carrier means the seller's job is to take the goods, right, to a location which the buyer has chosen. Maybe the buyer has chosen a shipping terminal. Maybe he has chosen a transport hub. So basically, that seller takes the goods to this location. Then we have the FAS, which is called free alongside ship. So the seller bring the good right beside the ship at the loading point. Once the goods are placed there, the buyer handle all the cost and all the risk. That is called FAS. FAS full form is free alongside ship, which means seller bring the good right beside the ship at the loading point, because the name itself say free alongside ship. So what is the role of the seller? Seller bring the good right to a location which is right beyond the ship at the loading point. Once the goods are placed there, the buyer handle all the cost and all the risk. Then we have free on board. So free on board, it means the seller gets the goods onto the ship at the port the buyer has chosen before agreed loading date, right? And after loading, the buyer is responsible. So FOB, as the name suggests, on board. On board means the seller responsibility is to get the materials put it on the board, right, on the shipping board, and buyer take remaining responsibility after that, be it insurance, etc, etc. Now the question is, what is CFR, right? CFR stands for, as the name suggests, cost and freight. So the seller pay to transport the good to the destination port, but the risk transferred to the buyer the moment the goods are loaded onto the ship. So the seller responsibility is to pay to transport the good to the destination port, but the risk transferred to the buyer the moment the goods are loaded onto the ship. What about CPT? CPT stands for carries paid to. Means the seller pay for transport to a specific place in the buyer's country. Could be a warehouse, could be depot, or could be the port. Then we have CIF. CIF stands for cost, insurance and freight. This is like CFR but with insurance included. Insurance here is also included, which is to be paid by the seller. So the seller handles shipping, insurance until the good reaches the buyer's port. Very common for bulk good and container. And finally, we have something called DPU. Okay, before that CIP I think we have discussed. So CIP, what is CIP? I told you seller will pay for both transport as well as insurance. So let's quickly summarize what we have covered so far. So we started with the EXW. I told you, in the EXW, buyer handle almost everything. In case of FCA, seller delivered to the buyer chosen location. In case of FAS, seller places the goods next to the ship, buyer take over. Then we have FOB. FOB, what happened? Seller loads the goods onto the buyer chosen ship. CFR, seller pay freight, right? Risk shipped after loading. Then CPT, then seller pays transport to the named place in the buyer country. Then we have CIF. CIF means seller pay high freight plus insurance to the buyer's port. And CIP, seller pay freight plus insurance to the buyer country, no import clearance. That is called CIP. Then comes DPU and DAP. So friends, let's finish our Incoterms with the last set of delivery items and a few important points. If we talk about DPU, it stands for delivery at the place unloaded, which means this one replaced the old term DAT. Earlier it was called DAT. Now this DAT has been replaced, right, in the Incoterms 2020. So the seller delivers the goods to the destination and never unload them. After unloading, the buyer control over the risk. So here the seller is delivering the goods onto the buyer's country port. Language, universal trade language, making it easier for buyer and seller across country to understand each other, compare price and estimate freight cost more accurately. But there is a limitation. Limitation is that they don't cover every possible situation, and sometimes the buyer and seller may prefer slightly different arrangement. So in real life, B2B often use EXW, CFT or CIF, and B2C, which is business to customer, they use CPT and or CIF, right, with DDP showing up sometimes. So in the B2B, business to business, right, it is actually EXW, CFT or CIF is used, while B2C, CFT, CIF all is used. Now for air freight, terms like EXW, FCA, CPT, CIP, DAT, DPU, DDP, these are compatible. Now friends, let's talk about the URC 522, right, an important set of rule in the trade finance. So URC stands for Uniform Rule for Collection. These are the guidelines created by the International Chamber of Commerce to make sure the collection of payment, debt or asset between trading partner is smooth and standardized. That is called URC. Now the latest version is URC 522, which came out in the mid 1990 and focused mainly on something called documentary collection, where bank handle important shipping and payment document on the behalf of buyer and seller, right. So one key rule is the remitting bank, that is the bank sending the document. Remitting bank must include clear instruction about why the collection is being made and how it should be processed, right. That is a very very important point, that remitting bank, which means the bank sending the document, it must include clear instruction why the collection is being made and how it should be processed. It also clearly explained two important methods. The first is called DA, which means document against acceptance, which means the importer only get the ownership document if they agree to pay later, usually by signing a bill of exchange. And the other is called DP, which means document against payment, which means importer get the ownership document only after making the full payment. So in other words, we can say DA is pay later, gets the good now, DP is pay now, gets the good. So quickly let's quickly division. So we talk about the URR 522. I told you this is the ICC rule for collection between trading party. Then we talk about URC 522. This is the latest version for documentary collection. I told you remitting bank must give clear collection instruction. DA, I told you this is the ownership document given after accepting to pay later, and DP means ownership document given only after amount full payment. Now friends, let's talk about the ISBP. What is ISBP? International Standard Banking Practices 745. Sometimes every banker dealing with letter of credit should know. Friends, if you want such kind of PDF, right, to revise the full content, you can WhatsApp me on this particular number shown on the screen, or you can enroll in our course for foreign exchange, whose link is provided in the description section. Right, many aspirants have cracked the examination going through our PDF and videos. There are separate course on PDF, there are separate course on videos. Also there is a Telegram channel in which memory based questions are being posted by the members. You can also join them. In the description section you will see the link, right. So these kinds of material will help you surely succeed in the upcoming examination. Now friends, let's talk about ISBP 745. So ISBP full form, you know it very well, International Standard Banking Practices, and the version 745 is the latest edition published by the International Chamber of Commerce. You can think of it as a practical guidebook that explains how to check document under a letter of credit. It works alongside UCP 600. It does not change the rule, but it clarifies how to apply them in real life. For example, if you see the article 19 to article 25 of the UCP 600 that deals with a transport document, but those rules does not apply if copies are presented instead of original. In such case, ISBP tell you what to do. So what I'm talking about, that if we talk in the context of UCP 600, especially Article 19 to 25, so they deal with the transport document, you know it. But the rule which has been listed in the Article 19 to 25 will not apply if copies are presented instead of original. So they will apply only if the originals are presented, right? In such case, ISBP will tell you what to do. Another example you can take for the airway bill. ISBP say carrier must identify themselves with more than just their IATA code. For instance, Singapore Airline is SQ, British Airways is BA, but they must also include extra identifier. Like airport still use their standard 3-letter code, like LAX for Los Angeles or LHR for London. Now the next point is, suppose a letter of credit mention a shipping mark. So ISBP allows some kinds of flexibility. The order of the mark on the document can differ from the order in the credit as long as the detail match. Right. So what I am telling you, that suppose a letter of credit mention a shipping mark, ISBP allows some kinds of flexibility. And when it comes to the bill of lading, if they meet UCP 600 Article 20 requirement, they can be issued by someone other than the carrier or captain, unless the LC specifically say otherwise. So let's just summarize what we have covered in this slide. So I started with the ISBP 745. I told you this is the ICC guide for checking document under letter of credit, right? Then it works with UCP 600. It clarifies rules. It does not change them. Transport rule like UCP 600, Article 19 to 25 does not apply to copies. ISBP give guidance. Airway bill need more than just IATA codes for carrier. Shipping mark can be in different order than the LC state. Bill of lading can be issued by other, not just carrier and captain, unless LC restricted. Some more point about ISBP 745, as you can see it. So let's talk about one of the biggest headache point in the trade finance, which is the document description, right, under the letter of credit. Many disputes happen when the way goods are described in the letter of credit does not match the way they are described in the invoice. According to the UCP 600, Article number 18, the description in the LC and the invoice must match. And the ISBP 745 stress the rule even more. But ISBP also gives some flexibility, that invoice can have some extra detail about the goods, performance or service, as long as these extra does not change the main category, classification, performance, type of services or nature of good mentioned in the LC. So yes, we are talking about ISBP giving some kinds of flexibility. Invoices can have extra detail about the goods, performance, services, as long as these extra does not change in the main category. Then if we talk to the context of bill of lading, so for bill of lading ISBP is strict. The port of loading must be exactly as stated in the letter of credit. Even small changes like Felixstowe or Felixstowe UK can cause a discrepancy. The same applies to the airway bill. So in short, exact matching is critical. Every time difference can cause your payment to be delayed or rejected, right? So let's just summarize what we have covered here. I told you that the letter of credit involved description. Letter of credit and invoice description must match exactly. That is UCP Article 600, UCP 600 Article number 18. Next point we talk about ISBP 745. I told you that ISBP 745 allow extra invoice detail if they don't change the nature of the goods, right? ISBP allow extra document detail if they don't change the nature of the goods. Bill of lading must show port of loading exactly as per the LC. They should show the port of loading exactly as per the letter of credit. And the last point I told you that even a small difference in the name can cause discrepancy applies to the airwheel also. Then let's talk about the URBPO. What it is all about. See, think BPO stands for bank payment obligation. You can think of BPO as sitting between the traditional letter of credit and an open account trade. It was created together by the International Chamber of Commerce and the SWIFT to make trade faster, safer and fully electronic. So how does it work? It is basically a paperless trade settlement system. What it is? Paperless trade settlement system. where the buyer bank, called the obligor bank, make irrevocable promise to pay the seller bank, which is called the recipient bank. See, two banks are there: buyer bank, which is called obligor bank; seller bank, which is called the recipient bank. So we are talking about BPO, which is called bank payment obligation, right? So we are talking to the context of URBPO, that is URBPO to be more precise, right? So BPO full form you must know, bank payment obligation. So you can think of BPO as a sitting between the traditional letter of credit and open account trade. It was created by the International Chamber of Commerce, right, and the SWIFT to make trade faster, safer, and fully electronic, right? So basically it is a paperless trade settlement system where the buyer bank, called the obligor bank, make an irrevocable promise to pay the seller bank, which is called the recipient bank, on a future date, but there is a condition. Condition is that the payment happen only if the trade data submitted electronically matches perfectly, right? So for that is called URBPO. For comparison, letter of credit follow UCP 600. So what is similar to LC? That in both payment to the seller is guaranteed if all agreed conditions are met, and in both cases a bank acts as like a trusted middleman. But here is the big difference. So you can see the similarity of URBPO with LC, that both ensure payment to the seller if agreed conditions are met, right? And in both cases bank act like a trusted middleman. So what is the difference? That LC require physical document to be presented, while BPO use electronic trade data only. No courier, no stack of paper, just clean digital matching. That's it. So friends, let's quickly revise whatever key points we have covered so far. So BPO stands for bank payment obligation. It is a kind of obligation between the LC and the opening account. It is endorsed by ICC and SWIFT, fully electronic and paperless. Buyer bank promises payment to a seller bank if trade data matches. It is governed by URBPO, which is under ICC publication number 750, while LC follow UCP 600. It is similar to LC, bank guarantee payment if condition met. What is the key difference? The difference is that LC have physical document, while BPO is all about electronic data, right? Now let's talk some more point about BPO. Let's go to a bit deeper into BPO, that is called bank payment obligation, and why it is becoming such a big deal in trade finance. A BPO assure payment to the seller. It reduces risk for both buyer and seller. BPO can even be used as collateral to get financing from a bank, right? So it assure payment to the seller. It reduces risk for both buyer and seller. It can even be used as a collateral to get financing from a bank. The BPO is an alternative trade settlement method, right? It is an alternative trade settlement method, not a replacement for LC, but a faster, fully electronic option. So if you look at the key difference between BPO and LC, so LC rely on paper document that need to be processed, that needs to be checked, while BPO, BPO work through electronic trade data exchange, no piles of paper, no courier. BPO is also more than just a payment tool, right? BPO is more than just a payment tool. It is a key driver for supply chain finance. This word that is called SCF. SCF stands for supply chain finance, right? So BPO is more than just a payment tool. It is a key driver for supply chain finance. That means supplier can get post shipment financing. Basically supplier can receive their payment earlier, improving their cash flow while the goods are still moving through the supply chain, right? So that is what I mean to say, that supply chain finance, that means supplier can get post shipment finance. After shipment supplier can get the finance. Basically when I say they can get their finance, it means they can receive their payment earlier, they can improve their cash flow while the goods are still moving through the supply chain. Now don't confuse a BPO with an electronic LC. It is not an electronic version of letter of credit. Sometimes people confuse that BPO is an electronic version of LC. No, not like that. The structure is completely different. BPO means bank to bank arrangement. LC usually bank to seller arrangement, or sometimes bank to bank, right? So when it comes to a speed, what's the difference between BPO and electronic LC? I told you that BPO is bank to bank arrangement, while LC is usually bank to seller, though sometimes bank to bank. When it comes to a speed, BPO is much faster than letter of credit because BPO is fully digital, right? So in terms of speed, it is also different. For verification, LC require manual document checking, while BPO use automated online data matching. And importantly, with BPO, shipment documents are not sent to bank at all. So let's quickly revise the key points which we have covered so far. So we started with BPO. BPO, BPO assured payment reduces the risk and can be collateral. Fully digital, no paper document in the BPO. Right, BPO drives supply chain finance. It enable early payment for the supplier. BPO is not the same as electronic LC. Structure wise, BPO means bank to bank, LC means bank to seller mostly. BPO is faster, automated check. LC is slower, manual check. Shipment document not sent to bank in BPO, right? While in the case of LC, shipment document is sent to the bank. So that is the difference between the bank payment obligation and the letter of credit, right? It has your payment to the seller. It reduces the risk for both buyer and seller and can be used as collateral to get financing from the bank. That is called BPO. Now friends, let's switch our focus to the URDG, which is Uniform Rule for Demand Guarantee. So today let's talk about URDG. You can think of demand guarantee as like a promise from a bank that if something goes wrong in the business deal, we will pay you. That is bank is promising. Now different country have their way of handling this guarantee, right? And that can cause confusion. That is where URDG comes in. It is a set of rule which is created by the International Chamber of Commerce, or in short we call it ICC. So it is a set of rule created by ICC to make sure that everyone is on same page, no matter where they are in the world. Now these rules make the whole process clear, fair and transparent. They explain exactly what each party must do and what they can expect. Following URDG help avoid arguments, misunderstanding and delays in payment, which means business run smoother, right? So now let's quickly revise the key points. We have started with URDG. I told you this is the global rule for demand guarantee. It is made by International Chamber of Commerce. It makes process fair, clear, efficient. It reduces the dispute and the delay. Simple, right? If you really think that this video is helpful to you, please hit that like button. Now friends, let's talk about ICC DocDex rule in simple term. So DocDex stands for documentary instrument dispute resolution expertise. Sound heavy, right? But in plain English, it is basically a special system made by the International Chamber of Commerce to quickly and fairly solve fight that happen in trade finance. Things like letter of credit, bank guarantee or collection. Now how does it work? If two parties are having a dispute about these kinds of document, the ICC bring in the totally independent trade finance expert. These experts don't take slides. They look at the submitted paper, they follow ICC rule and give a decision quickly. Right. It is run by ICC Center for ADR, that is ICC International Center for ADR, which is like the ICC on problem solving department. If the parties have not agreed on any other method to settle this dispute, the default method here is called mediation, right? So if the parties does not agree on any other method to settle their dispute, the default method here is called mediation, meaning they try to talk and settle first before fighting. DocDex rule is not new. It started in the year 1997, but over the year in 2002, 2015, they made it bigger to cover more things like trade loan, syndicated finance deal, and even fraud related issue. Right. So, and here is the cool part. It is all digital now. You don't have to send physical file. You can submit everything online using ICC templates. So in short, DocDex is a quick, expert-led digital dispute solving for trade finance run by ICC. Let's quickly summarize. DocDex is the ICC dispute resolution for trade finance. It covers letter of credit, guarantee and collection. It is administered by the ICC International Center for ADR. 3 independent trade finance experts review the documents. Mediation is the default if no other agreement exists, and it started in the year 1997, expanded in 2002 and 2015, right? Loan, syndication, fraud, all are covered. Fully digital with online templates. Now, let's talk about the export credit, right? So friends, let's talk about the pre-shipment finance, which you might have also heard as packing credit. So what is the idea here? It is basically money given to exporter before they ship the good. Why? So that they can buy raw material, they can process them, they can manufacture the product, or they can pack them nicely before sending them abroad. So this type of finance is controlled by RBI rule and usually comes with lower interest rate than normal business loan. Exporter can get this loan either in Indian rupees or in big global currency like dollar, Great Britain pound or euro, right? So exporter can get this loan either in the Indian rupees or in big global currency. Which big global currency we have already talked about, right? So when it is given in foreign currency, it is called PCFC or packing credit in foreign currency. Even if you are supplying goods from India's domestic tariff area, suppose you are supplying goods from India's domestic tariff area or an SEZ, special economic zone, it is treated as a kind of export, which we call as demand export, right? And yes, you can get export credit for that also. So we are talking about the pre-shipment finance controlled by RBI. Exporter can get this loan either in Indian rupees or in big global currencies, right? If it is given in foreign currency, it is called PCFC, packing credit foreign currency, and you are supplying goods from India domestic tariff area or to an SEZ, right? So this is kind of treated like an export, and this is called deemed export. What it is called? Deemed export. And yes, you can get export credit for that also. What is the meaning of deemed export? Deemed export means suppose you are supplying from domestic tariff area to an special economic zone. This export is called deemed tariff export. Now basically normally the exporter repay the loan from the payment they receive for that export order. Normally what happen? The exporter repay this loan from the payment that they receive for that export order. But there is also something called RAF. RAF stands for running account facility. Here repayment are done on first in first out basis. However, RAF is not applicable to sub-supplier. So what is the running account facility? Running account facility, here repayment are done on first in first out basis. However, RAF is not applicable to the sub-supplier. Sometime exporter might use money from one export order to repay the packing credit taken for other. That is called order substitution. And if the goods can't be bought right away after payment, say they are coming from far off market, the bank may give what is called clean packing credit. So let's just summarize what I told you, that pre-shipment finance is a loan before shipping to cover the cost. It comes in Indian rupees or foreign currency. If it comes in foreign currency, we call it PCFC. Then DTA to SEZ, it is called deemed export, and this is eligible for credit. RAF means first in first out repayment, not for sub-supplier. Order substitution means using fund from one order to repay another loan. Then we talk about CPC, which means when goods can't be purchased immediately, right? Let's talk more about this CPC. So basically you are into export or planning to get into it, then you must have heard the name like packing credit, duty drawback, ITC codes. Let's break this down in the super simple language. So CPC, you can think of it like a short-term loan to help you get good ready for export. But here is the twist. CPC is given only if your foreign buyer has already sent you some advance money and there is a gap between receiving that money and actually shipping the goods. Yes, only then CPC will be given. That means your foreign buyer has given you some advance money and there is a gap between the receiving that money and the shipping the goods. Then let's talk about the duty drawback. You know what it is? This is the government saying, hey exporter, we don't want you to pay extra tax on material that you use for goods that are going abroad. Government is saying to the exporter, hey exporter, we don't want you to pay extra taxes on material you are using for goods that are going abroad. So if you have paid custom duty on imported raw material or excise duty on Indian raw material, you can get that money back as refund. That refund is called duty drawback. Bank can even give you a loan against this future refund either before shipment or after shipment, right? That is called pre-shipment or post-shipment. Then we have the packing credit duration. So packing credit is a short-term export finance. The loan duration depends on your shipping plan, how long production will take, how long it will take you to get the raw material. So these are the factors on which the loan duration depends. If you don't submit your export document within 360 days, the concessional interest rate benefit is cancelled and you will be charged higher interest rate from the start. So within 360 days, you have to submit your export document. Otherwise, concessional interest rate will be forfeited and you will be charged higher rate. Now let's talk about the RBI refinance and interest rate. So RBI provide cheap fund to bank so that they can lend to exporter at the concessional rate, and the standard limit up to 180 days, extension extra 90 days, making total 270 days, but at slightly higher concessional rate. Now what is DGFT and ITC? DGFT is like the traffic controller for Indian export. It regulates trade via the EXIM policy. Every exportable product get an ITC code, a kind of passport for goods that tells if it can be exported and what rule apply. So let's just summarize what we have covered. CPC is the loan only if the buyer send advance and if there is a gap before delivery. Duty drawback means refund of custom or excise duty on export material. Bank can give loan against duty drawback at the pre or post shipment stage. Packing credit duration is fixed on shipping plan, production and procurement. Export document not given in 360 days, it will cause interest benefit will be withdrawn. RBI refinance 180 days plus 90 days extra at high concessional rate. DGFT regulate export. Product must have ITC or HS code. Let's talk about export documentation. So friends, exporting the goods is not about just packing and shipping. There are strict rules for paperwork, foreign exchange that exporter must follow. So let's start with the export by post. So you can send goods abroad through the post, but there is a rule. Before dispatch your export declaration form, or we call EDF, it must be signed by your authorized dealer bank. This is like getting official permission from your bank to send the good. That is called EDF, export declaration form, right? So you can send good abroad through the post, but there is a rule that before dispatch your export declaration form must be signed by your AD bank. What about the document submission? After exporting, you must submit the required export document to the same bank you mentioned in your declaration form, and you have to do this within 21 days from the date of export or the soft tax certification. So export by port is clear. Then I told you document submission, 21 days time is given to you, right? Date of export, how do we decide the date of export? It depends on the types of shipment. So by sea, it is the onboard date of the bill on the bill of lading. If it is by air, it is a date on the air consignment note. Other cases, it could be cross-border certificate or post parcel receipt date, right? Then, if there is a delay, if you miss the 21-day deadline, don't panic. Your bank can still process your export document without asking the RBI, as long as delay was for genuine reason beyond your control. What about the realization period? You must receive your export payment and bring it back to India within 9 months from the date of the export. What about the overseas warehouse? If you are sending goods to your own overseas warehouse, the payment period is longer, which is the 15 month. What about the receipt for the export proceed? See, payment must come through your authorized bank via foreign remittance, except for export to Nepal and Bhutan, which have different rule. What about ACU member payment? For export to the ACU member country like Bangladesh, Iran, Myanmar, Pakistan, Sri Lanka, the payment is done using the ACU dollar account system in India. Nepal is not part of this arrangement. So let's summarize the point which we have covered just now. I told you, post-export need EDF signed by a bank. After export, you should submit EDF, that is export declaration form, which is signed by the bank. Now submit document within 21 days. Export date is the date on shipping, air, post document. Delayed allowed if beyond exporter control. Payment 9 month or 15 month for overseas. In general it is 9 months and 15 months is there for overseas warehouse. You must route payment through bank and ACO system for a specific country. Then some more point we have talked now. Let's talk about export payment and finance. So first of all, payment from other country, like if an exporter in India sells goods to a buyer in other country, how will they get paid? So if the buyer is a non-ACU country, means not a part of the Asian Clearing Union, except Nepal and Bhutan, payment can be done in Indian rupees. But how? Either through a Vostro account, that is basically an account of a foreign bank in India, or in any permitted foreign currency like dollar, euro. So either they can make payment in Indian rupees through the Vostro account, or they can make payment in any foreign currency, right? Next come EDPMH, which is Export Data Processing and Monitoring System. See, that is the RBI Export Tracking Dashboard. Since 1 March 2014, it has been collecting export data from custom, SEZ, STPI, and all the data goes to RBI secure server, and then your bank get it to make sure exporter get their payment on time. Then come next point is GSP. GSP is called Generalized System of Preference. It is like a BIP pass for Indian goods in certain developed country such as European Union, USA, Japan, right, Canada, Australia, Switzerland, Norway, right? So this is called Generalized System of Preference. This is like a BIP pass for Indian goods in certain developed country, right? So these countries give low tariff on our export, making Indian goods cheaper there. Finally, we have something called finance. Yes, we have something called finance against export document. Yes, very important thing. This is the short-term finance given to exporter against their export bill. So it can be given at side draft, which is immediate payment. Bank buy the bill at the spot rate and give you the rupee value right away. Then we have the usance draft. So payment done after some time. So bank buy it at usance bill buying rate based on the maturity period. And finally we have under export letter of credit, which means they work like a bill purchase or discounting, depends on how long the payment is due. Let's quickly summarize the point which we have covered just now. I told you that non-ACU country except Nepal and Bhutan, payment in Indian rupees and the Vostro account or foreign currency. Then we talk about EDPMS, which is RBI export monitoring system since March 2014. Then we talk about GSP, which is generalized What is the meaning of GSP? GSP stands for Generalized System of Preference. So this is a preferential tariff for Indian export in developed country. Right. Then we talk about finance against export document. So at site, spot rate, UJAN's maturity rate, LC bill purchase or discounting rate. Right. Now let's switch our focus to the export finance, that is rupee advance and post shipment rule. So export finance, let's make this super simple. You imagine you are an exporter, you have shipped goods, and now you are waiting for payment from a foreign buyer. See the sequence how it is happening. That suppose you are an exporter, right? So you have made the goods shipment, and you are waiting for payment from a foreign buyer. Sometime instead of getting dollar or euro right away, you take financing in Indian rupees. So this is called rupee advance. Right, you are an exporter, you have shipped good, you are waiting for payment from a foreign buyer. So instead of getting dollar or euro right away, you take financing in the Indian rupees. So bank give rupees advance in cases like, first of all, the bill is in a currency that the bank does not normally deal with. Right. So this is called, non-position currency. Second is there is no exchange rate available for that currency at the moment. Third is the bill is drawn or payable in a specific list of country. Fourth is the bill is sent for collection and the exporter just want Indian rupees without converting to foreign currency. So bank give rupee advance in these kind of cases. Now there is also something called concessional interest rate. Basically it means cheaper interest rate. But these apply only to the post shipment finance during NTP. What is NTP? Normal transit period for side bill, which means payment on side, or NDD, which is period up to due date for UJAN's bill. So concessional interest rate apply for NDD, period up to due date for UJAN's bill, and for up to NTP, which is the normal transit period. So what is NTP? So NTP, you can think of it as average time from when the bank buy or discount your bill until the money actually reaches the bank nostro account from abroad. Right. So the time from where bank discount your bill and until the money actually reaches the bank nostro account. Now friends, the next point is so some special cases. If the bill was purchased after it was sent for collection, so NTP is counted from when it was sent for collection, not when purchased. If the exporter directly sent document to the buyer, a 25-day NTP start from earlier of the due date. The first is the when the document were sent to the buyer. Second is the when the copies were submitted to the bank branch. Finally, before giving any kind of post-shipment finance, the bank need a general power of attorney or GPA from the exporter authorized signatory on paper, on proper stamp paper, and it must be renewed every time. Right, every time the finance limit is renewed. So let's quickly revise the point. So we started with the rupee advance. I told you this is a kind of INR financing without buying foreign currency. It is given when non-position currency, no exchange rate, listed country, collection bill, without forex purchase. Now I told you about concessional interest rate. They are only using during NTP or NDD. NTP is the time till payment reaches bank nostro account. And direct dispatch by exporter, it takes 25-day NTP from earlier of the dispatch date or bank submission date. So remember, so let's quickly revise what was the point which I have cleared. The rupee advance means INR financing without buying foreign currency. It is given when non-position currency or no exchange rate listed country, collection bill without forex purchase. Concessional interest rate we talked about. So if it is a direct dispatch by exporter, 25 days NTP from the earlier of the dispatch date or the bank submission date. Then we talk about the crystallization of the foreign currency export bill. So imagine an exporter sell goods abroad and he has to get paid in dollar. Until the money comes, the bank is actually taking the exchange rate risk. Meaning, if the dollar rate changes, the bank could lose. So we are talking about the crystallization, right? So crystallization means imagine an exporter sell goods abroad. He has to get paid in dollar. So until the money comes in, bank is actually taking the exchange rate risk, right? Meaning if the dollar rate change, the bank could lose. To avoid this, bank convert that foreign currency bill into Indian rupees after a certain time. This process is called crystallization. So when does it happen? That if the exporter does not receive payment within 15 days after the due date, on that date, the bank takes the TT selling rate and crosses the bill and basically converted the bill into INR. So bank is ensured that foreign exchange rate may change, and because of which bank will face the loss. So what it does, it converts the foreign exchange currency liability into Indian rupees. So what happened? The risk move from bank to the exporter. Exporter can also request early crystallization in writing if both sides agree. Then we have bill of lading or BL. So that is the point. Now let's talk about the bill of lading. So exporter can request early crystallization. So bill of lading, you can think of it like passport of your goods. It is a legal document given by shipping company to the exporter that say that which goods are there, how much goods are there, right? Where they are. So this bill of lading, they work like how the bill of lading work like. The bill of lading work like a document of title, means whoever hold it on the goods, then the bill of lading work like a receipt, prove that the goods were loaded. And the bill of lading also work like a contract agreement between exporter and shipper. So if it say clean on board, it means the goods were loaded in the good condition, no damage in the defect. So basically, bill of lading work as a documents of the title of the goods. Whoever hold it on basically on the goods, it work like a receipt, means proof that the goods were loaded. It worked like a contract. So let's quickly summarize about crystallization. I told you, converting export bill from foreign currency to INR to shift the exchange rate risk from the bank to the exporter. So 15 days after due date, and it is done at the TT ceiling rate. Early crystallization is possible with a written request, and bill of lading is the legal document showing the goods detail. It acts like a title, receipt, and contract. Then if we talk about the types of bill of lading, so first of all we have the conference vessel bill of lading. You can think of it like booking a bus on a fixed timetable. So this bill is issued when your cargo is shipped on vessel that follow a fixed route and a schedule. Then we have the trans vessel bill of lading, opposite of the above. These ships have no fixed schedule and usually carry bulk good like coal or iron ore. It is like a truck that goes wherever the next big job is. Then we have short form bill of lading. This one is shortcut. It does not print all the rules on the document. Instead, it tells you to check with the shipping company for the detailed terms. Then we have through bill of lading. So through bill of lading, what happened? That your cargo, basically your cargo journey is covered from the first port to the final destination, even if changes stop in between. Then we have combined or multimodal transport bill of lading. So basically you can think of door-to-door services. This will cover the entire journey, including road, rail or inland waterway. Then we have direct bill of lading. So what is the meaning of direct bill of lading? As you can see here, that it means this is made directly in the consignee name. Ownership of the cargo passes directly from the sender to the receiver. Then we have country craft bill of lading, issued by a small vessel operator for the nearby country trade, like between India, Sri Lanka, Pakistan or Bangladesh. Then we have sailing vessel bill of lading. As the name say, cargo shipped on sail provided vessel. Rare today, but still exists in some region. And then we have charter party. So here when a ship is hired, the charterer issue the bill. That these terms are linked to the charter party agreement. So conference means fixed schedule. Tramp means no schedule, bulk good. Short form means brief, check rules separately. Thorough means covered multiple ships, same bill. Combined means include land plus sea journey. Direct means in the consignee name, ownership direct. Country craft means a small vessel nearby country. Sailing means sail powered ship. Charter party issued by the hired ship charting. Now we have some additional bill of lading. As you can see, first is the receipt for shipment bill of lading. You can think of this as a document which you deal with. It's called airway bill or AWB. You can think of it like a receipt from the airline saying, yes, we have received your good and we will transport them from one airport to the another. Now here is the catch. It is a non-negotiable document. Means it is not a proof of ownership of the goods. So whoever has it can't just claim the good. It is only proof that they were shipped. For exporter, there is a smart safety move that consign your good to a bank abroad instead of directly to the buyer. Why? Because if you send it directly to the buyer, they might get the goods before paying you. So the bank act like a middleman, releasing the document only after the payment. You may also hear about something called air consignment notes. So basically, this basically the same in the function as AWB, but again not a document of title. Two main types of AWB are there. Master AWB, that is called MAWB. This is issued by the main airline to a freight forwarder when the forwarder book goods with the airline. And the second type we have is HAWB, which is called House Air Waybill. This is issued by the freight forwarder to the shipper when you book goods with them. So the process work like this: you, the shipper, give goods to the freight forwarder. They give you an HAWB. Then they book the cargo with the airline. Airline issue MAWB to the forwarder for the same shipment. Now let's talk something about factoring and forfeiting. So factoring, imagine you have sold the goods to a customer, but they will pay you after 2 to 3 months. You need cash right now. You can go to a company that is called a factor, sell them your pending invoice or discount at a discount and get most of your monthly money instantly. So the factor take over the risk. If your customer does not pay, it's now the headache. It's not the headache of the factor, not yours. Factoring can work for both domestic and international transaction. So I hope it is clear now. Factor take over, that is factoring can work for both domestic and international trade. What is forfeiting? Forfeiting is also getting cash early, but here we are talking about export. If you are an exporter, you can sell your right to receive payment to a forfeiter and get instant cash. This is usually backed by formal document like bill of lading or promissory note. It is mostly used for capital good like big expensive item like machinery, right? Big machinery, and for medium to long term product. The repayment should be done in 90 days. For how bank handle dollar, how bank handle euro, how bank handle pound in the Indian market. It is officially registered under the Companies Act. So as you can see, they operate as a self-regulatory organization. So they are registered under the Companies Act, and only authorized dealer bank, that is called AD bank, those who are allowed to trade in the forex can be its member. Right, so officially registered under the Companies Act, and only AD bank, which are the bank which are authorized, which are allowed to trade in forex, only those bank can be its member. FIDE acts like a self-regulating body, means that it set its own rule for the smooth working of the India's foreign exchange market. Right, so what I am telling you, that FIDE acts like a self-regulating body, which means FIDE set its own rule for the smooth working of the India's foreign exchange market. Now they decide the guidelines for the how bank deal with each other in forex. They also train bank employee. I'm talking about FIDE, right? So FIDE, what it does, they decide the guideline for how bank deal with each other in the forex transaction, and they also train bank employee in handling international transaction, and even they certify the foreign exchange broker. Whenever member bank need to approach the government or RBI about forex issue, FIDE become their voice. They also publish daily and periodic currency rate for member bank to follow. Bank can still set their own service charge for forex transaction, right? And but FIDE ensure that a small customer who don't do big transaction, they are treated fairly, right? Now all member bank have to follow a 2017 code of conduct and submit a statement of commitment. And yes, in India, the official forex trading time is 9 a.m. to 5 p.m. on working day. Now friends, let's talk about FIDE, some more points related to the FIDE. So first point is that FIDE also have some extra rule that make forex operation smoother. So friends, FIDE also have some extra rule that make forex operation smoother. First of all, bank, they are also called authorized dealer or AD, right? So they can handle forex deal with other bank and customer even after the standard 9 to 5 timing on working day if needed, right? So that is called extended hour. Means bank can handle, authorized dealer or AD can handle forex deal with other bank and customer even after the standard 9 to 5 hour timing on working day if it is required. Even on Saturday, Sunday or holiday, individual customer, joint account holder or a small firm can do forex transaction, but only if their bank allow it, right? So that is the point. Now bank must always keep their net overnight open position or NOOP within limits, right? Remember, bank must always keep their NWP within limits. Basically, bank can't take too much risk by holding foreign currency overnight. This include trade done after market hour but before the next opening. So that is what I say, that NWP has to be maintained. Bank must always keep their net overnight open position or NWP within limit, which means they can't take too much risk by holding foreign currency overnight. When we talk about a spot date rollover for foreign currency or rupee deal, it simply means the trade date shift at midnight, right? It simply means that trade date shift at midnight. So that is the meaning of spot date rollover. It means trade date shift at midnight. Saturday is not a normal working day for forex except for certain special transaction. FEDE also classify holiday into two types: known holiday, which is announced at least 3 working days before, and sudden holiday, which is declared without prior notice. So known holiday means announced at least 3 working days before, and sudden holiday declared without prior notice. If you are handling foreign currency bill like export import, payment document, bank buy, bank discount, bank negotiate them at the current or agreed rate. So for handling foreign currency bill, right, bank buy, discount or negotiate them at the current rate or at the agreed rate. That is called bill handling. Now if a forex liability needs to be converted into Indian rupee, the bank will use the TT selling rate. This process is called crystallization. So suppose there is a forex liability which needs to be converted to Indian rupee. So bank will use something called TT selling rate. This process is called crystallization. When money from a forex deal is received, it is called realization. So money from forex deal is received, it is converted using the TT buying rate or the agreed rate. So when forex liability needs to be converted to Indian rupee, this is called TT selling rate. And when money from forex deal is received or realized, it is converted using the TT buying rate or the agreed rate. Now if a bill is not honored before crystallization, the bank will collect the Indian rupees value plus forex charge at the TT selling rate. Suppose some bill is there, it is not honored before crystallization. What will happen? The bank will collect the INR value plus the forex charge at the TT selling rate. Now if the payment is received early, the bank refund the interest for unused period. And suppose if a forward contract is closed early, the notional swap cost is either charged or refunded, just like early delivery charge. Lastly, the transit period is simply the average time it takes from when the bank buy or when the bank discount a bill to when money actually arrive. So that is the meaning of transit period. Means the time it takes from when the bank buy or discount a bill to when the money actually arrive. Right. So these are the important rules you must remember. Now some more important points related to the FEDE. So let's talk about more FEDE operational rule. Suppose if an export bill already has a fixed maturity date. Now friends, let's suppose that an export bill is there which already has a fixed maturity date. For export Ujans bill with fixed maturity date, it means the payment due date is set in advance. The normal transit period does not apply, right? So for export bill already having a fixed maturity date, right, in that case normal transit period does not apply. But when the same bill is drawn on demand or on site and not backed by a letter of credit, the normal transit period is 25 days for foreign currency bill and 20 days for rupee bill. So to see the difference, export bill is there, fixed maturity date is there, payment due date set in advance. The normal transit period will not apply in such case in the case of Ujans bill. However, if it is a site bill, there is nothing something like normal transit period. But for demand and side bill, normal transit period is 25 days for foreign currency bill and 20 days for rupee bill. And suppose if a bank give finance beyond this transit period, the maximum allowed is 90 days from the shipment date. Right. So for finance on export bill beyond NTP, maximum tenure is 90 days. Now one more point is that once a bill is purchased, discounted or negotiated, you can't change its due date. It is fixed. So once a bill is purchased, when an export bill is purchased, discounted or negotiated, its due date cannot be changed. It remain fixed. Now suppose it is rupee bill under the letter of credit. FEDE sets reimbursement time, maximum reimbursement time. If it is same city, which means reimbursement at the negotiation center, or same city, it is 3 days. Then if it is reimbursement at the different Indian center, which means different city in India, then 7 days. Then it is reimbursement by a foreign bank, then 20 days. If it is export to Russia, it is 20 days. And if it is electronic reimbursement, it should be done within 5 days. So what I am telling you, for a rupee bill under a letter of credit, FEDI set maximum reimbursement time, which is 3, 7, 20 and 5 days as shown here. The next point is when export proceeds are received from collection or consignment sale, they are converted into INR at the TT buying rate or the agreed rate. So suppose export proceeds they are received from collection or consignment sales, they are converted into Indian rupees at the TT buying rate or at the agreed rate. But remember, bank only convert once the foreign currency credit actually happen in their nostro account, that is their account in the foreign bank. So conversion will only happen, right? What I'm telling about, what about conversion? So we are talking about conversion to INR, right? At the TT buying rate or the agreed rate. So suppose export proceed is received from collection or consignment sale, so they are converted into INR at the TT buying rate or the agreed rate. But conversion will only happen once the foreign currency credit actually happen in the nostro account, right? And after that, once FEMA rule are met, their exporter must be paid within 2 working days, right? So after receiving credit and fulfilling all guidelines and FEMA requirement, bank must credit exporter within 2 working days. If there is a delay, the bank must pay compensation at the minimum export credit interest rate. So what I am telling you, that bank only convert the foreign currency credit into Indian rupees in their nostro, which actually appear in the nostro account. And after that, once FEMA rules are made, the exporter must be paid within 2 working days. And if there is a delay, bank must pay compensation. So this is the rule regarding the export bill. What about retirement of the import bill? So for import bill, if the payment is hedged, use the contracted hedge rate. Or if the payment is not hedged, use the current bill selling rate. So these are the 2 conditions. If it is hedged, use the contracted hedge rate. If it is not hedged, then use the current bill selling rate. Now suppose you want to crystallize the, crystallize the import bill. That is called crystallization of import bill without a hedge. Bank also apply the current bill selling rate. And now suppose the import bill is under letter of credit. There also normal commercial interest rate apply. And finally, outward remittance like sending money abroad, this is done at the TT selling rate or at the agreed forex rate, right? Now let's look at some other operational guidelines of this FEDI. So we talked about when money comes into India for abroad, that is called inward remittance. The bank convert it at either TT buying rate or whatever rate was agreed in the contract. Yes, I am again and again repeating, for inward remittance we always use the TT buying rate or whatever rate was agreed in the contract, because money is coming to India from abroad, so TT buying rate to be used. Now authorized dealer bank must credit the money to the beneficiary or at least inform them within 2 working days of getting the credit advance of their nostro account statement. What happened whenever inward remittance occur, it first get credited to the nostro account. So after crediting to the nostro account within 2 banking days, the bank must inform the customer, right, of getting the credit advance. If they delay, the bank has to pay interest at 2% above the saving bank rate. So because of the delay beyond this 2 working day, and what will happen, the bank has to pay interest and also cover any loss due to the exchange rate change. Now suppose the beneficiary does not reply within 5 working days and the money have not been returned. The bank will crystallize it, meaning they will convert to INR at the applicable rate. Suppose the beneficiary, whoever has to receive the amount, does not reply within 5 working days, right? Right. So does not reply within the 5 working day. So what will happen? The money has not been and the money has not been returned. The bank will crystallize it. Now, if there is a dispute between 2 banks, right? Suppose there is a dispute between 2 banks. So in the case of dispute between 2 banks, FEDI can step in. They will set up a 3-member subcommittee to review and give the direction. So if there is any kind of dispute between 2 banks, FEDI can step in. They will set up 3-member subcommittee to review and give direction. Now for exchange contract, basically agreement to buy or sell foreign currency, the deal must mention a fixed amount and a set time period. Now there is something called delivery date option. If the delivery date is not fixed, customer can get an option period or up to 1 month to decide when to take delivery. So suppose delivery date is not fixed, then option period may be allowed maximum 1 month at the customer discretion. And if the delivery date is fixed or last option date fall on a known holiday, delivery will happen on the previous working day, but if a suddenly holiday is announced, delivery will move to the next working day. This is a very very important thing. The concept of known holiday and and the concept of sudden holiday. So suppose I am talking about the delivery date. If the delivery date is not fixed, customer can get an option period of up to 1 month to decide when to take delivery. And then we talk about the known period and known holiday and customer holiday. Now there is something called sudden holiday. I told you if the sudden holiday occur, delivery move to the next working day. Now let's talk about the types of contract. In forex trading, different contract types simply means different delivery timeline. The first kind we have is called ready or cash contract. What happened here? The currency is delivered the same date you make the deal. The second kind of contract is called value next day contract, which means settlement happen on the next working day. A spot contract, which means delivery is done on the second working day after the deal. Forward contract, which means these are settled on the date beyond the spot date, basically in the future. Friends, if you are looking forward for such kind of PDF, for quick revision session, for the unit wise theory and MCQ PDF and previous year question, you can enroll in our course. There is a separate course for PDF, there is a separate course for videos, right? You can WhatsApp me on the number 8292857381, or again I am repeating 8292857381, or in the description section of the video you will get the course link. You can enroll there. So we are talking about the forward contract. What I told you, that these are settled on the date beyond the spot date. Now while calculating how long the contract lasts, FEDI count from the spot value date, right? FEDI always count from the spot value date. This is a very important rule, not the day you sign the deal. And all contract clearly mention where and what bank the payment or delivery will take place. One more point is that exchange rate must always be quoted as a number of rupees and paisa for 1, sometimes 100 units of foreign currency. For settlement, the rupee amount can be rounded to the nearest rupee or paid exactly to the paisa. If a customer want early delivery or early acceptance of currency, the bank will charge or pay any swap cost and also adjust interest for the fund. Suppose if the customer need more time, so an extension of the forex contract, the bank cancel the original deal at the current rate and immediately book a new one. So any difference in the rate is charged or paid accordingly. But there is a rule. The rule says that customer must ask for extension before the contract maturity date. Now let's look at some more FEDI important point regarding cancellation and delivery. So suppose if a customer want to cancel a forex contract or before a maturity date, he want to cancel it. The bank will either charge or pay them the difference between the original contract rate and the cancellation rate. So two rate will be there. There was the original contract rate and the second rate will be cancellation rate. So you have to see the difference. So that is the point. Now, if for purchase contract, which means you are buying foreign currency, cancellation is done at the TT selling rate, and for sale contract, which means we are buying, in which we are selling foreign currency, cancellation is done at the TT buying rate. Remember, they are the reverse, they are the opposite. Now, if the cancellation happened before maturity, the bank uses the relevant forward TT rate. Now, if the customer gives no instruction, the bank will cancel. Basically, suppose the customer give no instruction, the bank will cancel matured contract within 3 working days after maturity. So if the customer give no instruction, bank will cancel mature contract within 3 working days after maturity. If cancellation happen after maturity, the customer loses any potential profit from the exchange rate changes. And if the for early delivery of currency, bank always recover the swap cost from customer even if no real swap transaction is carried out. So bank always recover the swap cost from the customer even if no real swap deal is carried out. On the top of that, if a bank has to arrange fund for the swap, it also charges interest rate. Now, if the early delivery swap result in money flowing into the bank for the customer, bank will pay interest to the customer. All these costs and interest are calculated based on the difference between the original contract rate and the rate used for arranging the swaps. Now let's talk about FIDE, some more points like market intermediary. In the forex market, bank often use intermediary like exchange broker, multi bank portal, electronic order matching system to connect buyer and seller. And there is a rule which says that bank can only deal through intermediary approved by the FIDE or RBI, right? No bank can pay brokerage or commission to employee of another bank for helping with the forex deal, right? To avoid conflict of interest. So that is the point regarding the exchange broker, right? So the rule is that bank can only deal through intermediary approved by FIDE or RBI, and no bank can pay brokerage or commission to employee of another bank, right? I told you. Then there are something called voice broker. What is the meaning of voice broker? Voice broker are the old school matchmaker. They still exist, connecting bank through phone call instead of fancy online platform. Every forex contract, confirmation or advice must carry the line, subject to the rules and regulation of the Foreign Exchange Dealer Association of India. So this rule is this word is the common, right? So why it is necessary? So that everyone knows the FIDE rule apply. Then we have another big rule. Intermediation is not basically another big rule. Intermediary can't act as a principal in deal. This means they can't be the actual buyer or the seller of the currency, only the matchmaker, right? So when a bank deliver or receive currency, it must be directly to or from the disclosed authorized dealer. So no hidden charges will be there. So that is called no hidden charge. What I am telling you, that whenever a bank deliver or receive currency, it must be directly to or from the decision authorized dealer. No hidden charges. Then I told you that suppose if the currency including rupee is delivered late, if suppose the currency is delivered late, what will happen? The penalty is increased as 2% above the benchmark rate. We are talking about the claim settlement deadline. I told you that suppose a claim is delayed, claim for delayed forex fund is filled after 15 working day from the due date. So it is filled after 15 working day from the due date, right? If the claim is filled 15 working day after the due date, the selling bank interest liability is capped at 60 days, which means they won't pay interest for delay beyond 60 days. Then if suppose the claim is filled on time, so the seller bank must settle it, including any overdue interest, within 15 working days of getting the claim. If the seller takes more than 15 days to settle, they have to pay interest for the entire overdue period at a specified rate, and this time there is no 60-day cap. Suppose a claim remains unsettled for 60 days from the date it was lodged, it can be taken to FIDE, whose decision will be final and binding. For a forward contract with a delivery option, the buying bank must give at least 2 working day notice before they plan to take delivery. All interbank forex forward contract must be settled through CCIL forex forward system, which is a central platform for clearing, right? Remember, all kinds of interbank forward contract, they must be settled through CCIL forex forward system. If an option expiry date fall on a known holiday, suppose an option expiry date fall on a known holiday, the expiry move earlier to the preceding working day, and if it is sudden holiday, the expiry move forward to the next working day, right? Now let's look at the foreign exchange rate and risk management. Foreign currency is simply money from another country like dollar, British pound, Japanese yen. That is foreign currency. And foreign exchange or forex is the process of swapping one currency for another, usually done at the bank or authorized forex center. So forex trading always happen in pair. You buy one currency while selling another at the same time, right? Then I told you about exchange rate. Exchange rate tells you how much of your country currency equal 1 unit of the other currency. There are two main types of exchange rate. The first is called fixed rate, second is called floating rate. Fixed rate means central bank decide the rate and control it. Floating rate means the market based on demand and supply decide the rate. There are also 3 exchange rate system. The first is called fixed or peg rate system, which means rate is tied to another currency. Flexible or floating rate system. What happened in the fixed exchange rate system? Rate is tied to another currency. That is called pegged system. Flexible and floating system, what happened? That rate changes freely with the market. No government interference is there. And then we have managed floating system, which is mostly market driven, but the central bank step in occasionally to adjust the thing. Now some more points related to it, let's discuss it. In a managed floating system, the currency value mostly follow the market, but the central bank jumps in when required, buying or selling currency to keep things in check. That is called managed floating system. Now a currency option is like a special deal that give you the right but not the obligation to exchange one currency for another at a fixed rate on a set date. Retail trader mainly use two types of this floating system. One is called call option, other is called put option. So call option is a right to buy a currency pair later at a locked in rate, and put option is the right to sell a currency pair later at a fixed rate. That is called call option and put option. In the call option, basically the right to buy a currency pair later, and put option is the right to sell a currency pair later. There is also called spot option, which is simpler to use, but you pay a higher upfront cost, which is called premium. So whenever you hear this FX option, Forex option, currency option, they all means the same thing. The option price depends on two parts. The first is called intrinsic value, which is what you would gain if you would use the option today. And the second is called, time value. Time value is the extra potential gain from now until the option expire. Finally, a European style option can only be used on the expiry date, so only the exchange rate on that day matter. Now friends, let's switch our focus to the next point, that is American style option and European style option. American style option, is a more flexible than the European kind. What happened in the European? That it can only be exercised at maturity. So the exchange rate on the expiry date is relevant. While in the case of American style option, what happened? It is more flexible. It can be exercised at any time, right? Up to and including the expiry date. So it offers more flexibility. But American option is a costlier than European style. So one way to remember it, E for European, E for expiry. So I told you, European option can only be exercised at expiry. And American option, is more flexible. You may use it at any time before it expires. Now, the Forex market is where people and institutions buy and sell different currency worldwide. In India, Forex market has two parts, a spot market and the forward market. What happened in the spot market? Immediate currency exchange happen. What happened in the forward market? That currency exchange at a future date at a rate decided today. India's exchange rate is floating. It means market supply and demand set the value, but the RBI steps in when things get too volatile. So friends, in India, the Forex market has, two main parts. What are the two main parts? A spot market and the forward market, right? So what happened in the spot market? Immediate currency exchange. What happened in the forward market? Basically currency exchange as a future date, as the rate decided today. And India's exchange rate, it's floating. Means market supply and demand set the value, but the RBI steps in when the things get too volatile. Now there is something called, Forex market main job are to let people swap currency and to protect them from currency related loss, which is called hedging, right? So we have three main Forex system, spot, forward and future, right? These are the three main Forex system, spot, forward and future. So what does it mean? So, the law governing foreign exchange is now FEMA, which replaced the older FERA. And it must simple because, only 49 sections are there. Right, how many sections are there? Only 49 sections are there, as you can see. What is exchange rate risk? So exchange rate risk is when suddenly currency changes can affect a company value. The risk come in three main types. The first is called translation, the second is called transaction, and third is called economic. So what is this transaction? Transaction risk means when currency change messes with the money you expect to receive or pay. Like in the case of export you receive, in the case of import you pay. So when currency changes mess with the money that you expect to receive or you expect to pay, or the dividend that you bring back, that is called transaction. Second thing is called translation, which affect how foreign asset and liability are valued in your book. And third is called economic. Economic means changes in currency value can impact the entire future earning power of a business, right? So translation, transaction and economic. Translation means it affects how foreign asset and liability are valued in your book. Now some more kinds of risk are direct transaction risk. It is when a change in the agreed currency rate hit your profit straight away, right? So you have agreed a currency rate, and this change in that agreed rate it hit your profit. Then we have the translation risk. It is when your company asset or income look bigger or smaller in your book because of the currency rate change. That is called translation. And economic risk, it is a bigger picture. Currency shift can affect your future sale. It can affect your future cost, both at the home and abroad. That is called, economic risk. Then we have the VAR model, that is called value at risk model. It is like financial weather forecast. It tells you the worst loss you could face from currency move over a set time with a given level of certainty. Yes, it tells you what is the worst loss that you could face from the currency move over a set time, right? So that it is stated always as a confidence interval, which is called Z percentage. Common cross currency swap are coupon swap and basis swap. If we talk about cross currencies coupon swap, they are fixed interest in one currency, floating interest in another. And if we talk about the basis swap, they are floating interest in one currency, swapped for floating interest in another. So coupon swap means fixed currency in one currency, fixed interest in one currency, floating interest in another. So fixed and floating, right? And basis means what? Floating interest in one currency, swap for floating interest in the another. That is called basis swap. Then we have the plain vanilla call option. It is simple, bet on currency going up. You buy the rights to get it at set price, but you don't have to use it. That is called plain vanilla call option. Currency futures are a standard, extended deal to buy or sell a fixed amount of currency at a set date in the future. Now, let's talk about FX Global Code. What is this foreign exchange global code? It's like a rule book for good behavior in the global currency market. So, rule book for good behavior in the global currency market. It is designed to make the big wholesale forex market more trustworthy, more efficient. This forex global code it was put together by central bank and private market expert working together under the markets committee, right? So I told you it was put together by the central bank and the private market expert. They were working together under the market committee. This code has 55 principles, basically guidelines everyone can follow to keep the market fair and responsible. What is the goal of this code? The goal is to keep the market strong, fair, liquid, open, transparent. This Forex Global Code is not just a law, it is just the best practice advice. It is overseen by the GFXC, which is called Global Foreign Exchange Committee, which started in the May 2017 to bring together banks and market players to share ideas and tackle new issues. The code is built on 6 main pillars. What are the 6 main pillars? Ethics, governance, execution, information sharing, risk management, compliance, and confirmation and settlement. Now let's talk about the regulatory requirement under FEMA for resident and non-resident individual. FEMA is India rulebook for handling money that move in and out of the country. It came into effect in the year 1999 and covered transaction by both Indian as well as the NRI. What is the main job of FEMA? Is to keep cross-border currency flow smooth, safe, and well organized. If you become an NRI, you can't keep your regular resident saving account in India. Instead, you can choose from 3 different special accounts: NRE account, NRO account, FCNR account. NRE stands for non-resident external, NRO stands for non-resident ordinary, FCNR stands for foreign currency non-resident account, right? So NRI can open any of these with an authorized bank in India. You can send in as much foreign currency as you want, no limit is there. But if you bring foreign currency, traveler check or bank note into India, you must declare them into custom using the currency declaration form. There is something called CDF, using which you must declare them to custom, right, if they exceed the state limit. So if you bring currency, traveler check, bank note into India, you must declare them to the custom using something called CDF, currency declaration form. Now let's talk more about this CDF. If you are an NRI bringing money into India, you don't need to fill a currency declaration form if you are carrying foreign currency note up to $5,000. So if you are carrying up to $5,000 note, you need not you need not bring currency declaration form, and you also did not need to fill currency declaration form if you are carrying currency plus traveler check together up to $10,000. So foreign currency note up to $5,000 and currency plus traveler check together up to $10,000. In that case, you need not fill currency declaration form. You can freely buy residential or commercial property in India. You can also get property as a gift or through inheritance from certain relative, right? So these are the points. And some points are, but you cannot buy agriculture land, farmhouse, plantation unless you inherit them. NRI can invest in India share, mutual fund, other instrument, but only under the RBI rule. Now you can inherit any property in India without restriction, and you can gift asset to Indian resident, but only within RBI set limit. Your residential status for tax purpose depends on how long you stay in India. If you stay 182 days or more in a year, you are a resident. Or if you stay 60 days or more in a year and 365 days or more in the last 4 years, you also a resident. That is called ROR. So if you stay in India more than 182 days in a year, you are ROR. If you stay more than 60 days in a year, but in the last 4 years you stay more than 365 days, then you are also ROR. To be ordinary resident, you must have been resident for at least 2 out of the last 10 years. These are the very, very important rule. Now friends, if you are a resident, an ordinary resident in India, and the taxman want to know about all your income in India and abroad, if you are a resident but not ordinary resident, that is called RNOR, meaning you have been a non-resident for 9 out of the 10 years, or you have stayed in India for 729 days or less in the last 7 years, then you only pay tax on the income earned in India, income received in India. Your foreign earning stay tax free in India. So for RNOR, for RNOR, they are liable to pay on tax on income in India. They are not liable to pay their income which they have received outside India will not be taxable. But if you are a non-resident, you are only taxed on income earned or received in India. Foreign income is completely off the hook here, right? So you can also file an Indian tax return only if your Indian income is over 2.5 lakh a year. Also, there is something called DTAA, which is called Double Taxation Avoidance Agreement, an agreement between the countries to make sure that you are not taxed twice on the same income. One important note is that the rule for deciding if you are a resident differ under the Income Tax Act and the FEMA Act, and that can affect both your tax and your forex rule. Now friends, let's talk about the residential status IT Act versus FEMA. Under the Income Tax Act, you are either a resident or a non-resident for the whole financial year. You are a resident if you have been in India for 182 days or more in that year, or 60 days or more in that year, and 65 days or more in the past 4 years. Under FEMA, it is different. This is about in IT Act. But FEMA, what FEMA say, that it is about whether you stay in India for more than 182 days in a previous year or not. And your status can change within the same year here. That's the difference. The main difference is that IT Act says that one status for the whole year, but FEMA says that status can change partway through the year. Citizenship matter for the IT Act tax benefit, but not at all for FEMA. Nationality does not matter in either law. Why it matter? IT Act decide if all your global income get taxed and whether you need to fill ITR. And FEMA control your cross-border transaction and things like LRS, Liberalized Remittance Scheme, which is not allowed for non-resident. Remember, LRS is never allowed for non-resident, and that is decided using the FEMA, right? So under FEMA, your residential status change from a specific date, not for the entire year. Remember it, very, very important. Now let's shift our focus to the LRS. I again tell you that if you want such kind of PDF which is short and concise notes, you can enroll in our foreign exchange PDF course. In the description section of the video, you will get the link of the course, right? Now friends, what is LRS? Indian foreign exchange dealing with follow the FEMA rule, right? It has been placed since the 1st June 2000. FEMA is split transaction into two types: current account transaction, capital account transaction. So current account means everyday payment that do not change your overseas asset or overseas debt, and capital account means deal that create or change overseas asset or debt directly. Section 5 of the FEMA say resident can freely sell foreign currency for any current account purpose unless the government has specifically restricted it. So that is the section 5 of the FEMA, which says that resident can freely buy or sell foreign currency for any current account purpose, right? Unless the government has specifically restricted it. So to make sending abroad easier, RBI introduced something called LRS, Liberalized Remittance Scheme. So under the LRS, any resident Indian, yes, even minor also, they can send up to $2.5 lakh per financial year for approved purposes, whether current account, capital account or both, but not allowed for companies, partnership, right? Who is eligible? I think it is clear. Who are excluded? Company, partnership, Hindu or divided family, trust, or any non-individual. They are not included. And if a minor is sending money, their guardian signed the required form A2. Remember, if the remitter is a minor, if the minor is sending money under the LRS, so their guardian must sign the form A2, right? They must fill the form A2. Some more points regarding LRS. LRS is only for Indian resident, and the money must go out from your saving account. You can send money for family member, but each person has their own USD 2.5 lakh yearly limit. You can't pull it together for a capital account investment until you are a joint holder. You can't gift foreign currency to another Indian resident to put into their overseas account under LRS. This is a very important thing. No resident to resident gift abroad. It is not permitted for one resident to give foreign currency as a gift to another resident. Then another point is the US dollar 2.5 lakh limit cover everything: travel, education, medical cost, family maintenance, capital account investment. Everything is covered. And if you want to send more than the limit, you need RBI approval first. Bank can't give loan to help you send capital account remittance under LRS. Very, very important, right? So bank cannot give you loan so that you can send capital account remittance under LRS. Certain purposes are totally banned. And you cannot send capital account fund to country on the FATF blacklist. You know, some countries are registered on the FATF, that is called Financial Action Task Force blacklist, right? They are blacklisted. So you cannot send capital account fund to those countries. And before sending, you must fill form A2. This is the official declaration to buy foreign currency. Now some more points related to the FEMA. To send money under LRS, you must have a PAN card. You must give an you can give interest-free loan to your NRI or your PIO relative only by check or online transfer. But it must be for at least 1 year. It should be within your $2.5 lakh limit. The money can only be used for personal need or business in India, not for the banned purpose. And it must go to their NRO account in India. And it cannot be taken out of the India. So you can give loan under LRS to your NRI and PIO, but there are some certain conditions. Minimum year, 1 year. Minimum 1 year. 2.5 lakh limit, within 2.5 lakh limit. This money can be used for personal need or business in India. It must go to the NRO account. It cannot be taken out of India. And they can repay you through inward remittance or inward remittance their NRO, NRE, FCNR account, or by selling permitted asset. You can gift rupee fund, right? So you can this is a very important thing. You can gift rupee fund to your NRO PIO relative, but again it must go to their NRO account and it count toward their 2.5 lakh limit, $2.5 lakh limit. That gifting is allowed, but only it should be credited to their NRO account. Some more points, under LRS, NRI can move up to $10,000 per year from their NRO account. Very, very important. NRI can move up to $10,000 per year from their NRO account. But if it is from NRE and FCNR account, there is no such limit. Because, complete repatriation from NRE and FCNR account is allowed. But from NRO account, there is a limit, which is $10,000 per year. If you invest abroad under LRS, your profit are taxed in India. Whatever profit you earn, it will be taxable, because you are investing under LRS. If it is held over 2 years, then 20% LTCG will apply, that is called long-term capital gain tax. And if it is held up to 2 years, then tax at your regular slab rate. And suppose you are sending more than 7 lakh a year, the bank will collect 5% TCS, which is called, tax collected at source, which you can claim back while filling your ITR. LRS is for sending money out of India, not bringing in. Inward remittance follow FCRA rule for individual companies receiving foreign fund. There is no limit on how many times you can send money, but the total in the year should not exceed 2.5 lakh per dollar. Remember, if you go through the book, it has been written in paragraph. You cannot figure out what to skip, what to read, given the time constraint that you have. And the main purpose of this short revision session is the same, that I am providing you all the important points that you need for your examination. If you cover this much, it has been proven, it has been guaranteed by the earlier aspirant that they have acquired 50 marks easily in the examination. Now some more points. And to get PDF, you can WhatsApp me on the number 8292857381, or in the description section of the video, you will get the link to the course also. Now friends, under LRS, the yearly cap, you know it very well. Once you hit that limit, you can't send more than that in a financial year, even if you bring back some money from investment. You can send current account remittance to any country, including Mauritius, Pakistan, without extra rule. Money can go in any major currency that is freely convertible. Currency choice is anything. Now bank can't fund your capital account remittance under LRS. Again I am repeating. Suppose you are remitting the capital account, right, for capital account fund. So bank cannot fund you, bank cannot provide you loan. But they can help finance current account remittance like travel. Yes, bank can help finance the current account remittance. This question can be asked. Can bank finance for capital account remittance? The answer is no. Right. Now, a resident can't keep foreign currency account in India under LRS. Right. It's very, very important. You can't keep foreign currency account in India under LRS. There is something called, offshore banking unit. Offshore banking unit in India does not count as an overseas branch for opening such account. Right. So if you want to open such a LRS account, offshore banking unit in India, it does not count an overseas account. If you run a sole proprietorship, your personal and business remittance share the same $2.5 lakh limit, right? So you can open and maintain a foreign account abroad without RBI approval if it is for LRS purpose. Yes, for LRS purpose, you can open an account and you can maintain it abroad for LRS purpose. For donation, remember, only individual can use LRS. Other entity can donate separately,
but are capped at 1% of the past 3-year forex earning or $5 million, whichever is less. So if we are talking about the individual, for individual you can use LRS for donation, but suppose it is non-individual, like it is company, like it is partnership firm. In that case, the donation is capped at 1% of the past 3-year forex earning or $5 million, whichever is less. Now friends, let's talk about the foreign currency account. A foreign currency account is super handy if you deal with money across border. It is like multi-currency wallet. One account that can send and receive in different currency with just one set of deal. You can keep it in India or you can keep it abroad. If it is in India, it is called onshore. If it is abroad, it is called offshore. A multi-currency account saves the hassle of juggling multiple bank accounts and let you take advantage of the exchange rate change. For exporter and certain business, there is something called EEFC account, Exchange Earner Foreign Currency Account. You know about it, right? Where you can park your entire foreign earning. But here is the catch. The catch is that you must convert unused balance into rupee by the end of the next month after using what is needed for import or similar approved purpose. So whatever money in the foreign currency has to be converted into Indian rupees by the end of the next month, right? If RBI already allow you to keep a foreign currency account abroad, you can't also have an EEFC in India. Also, if you receive foreign currency from someone's EEFC account, you can't get an EEFC account yourself. Now, some more foreign currency account is listed here. EEFC account can only be in the 5 currency. What are the 5 currency? Dollar, Great Britain pound, euro, Australian dollar and Canadian dollar. And they don't earn interest. No interest is that. Good news is that there is no minimum balance, but you cannot use them as collateral for loan or let bank put a lien on them. You can add a close relative as a joint holder, but they can't touch the account while you are alive. For NRI returning to India, there is the RFC account, which is called Resident Foreign Currency Account. It can be current account, saving account, term deposit account. You can keep it in the same 5 currency. You can use the money freely for any allowed overseas payment or investment. RFC are perfect if you are moving back permanently and want to keep your foreign money in the foreign currency. But no checkbook are given for the RFC saving or current account. Now, so I hope it is clear. So where it is useful for, right? Some more points related to it. Let's talk about the minimum for opening. Yes. So what we are talking about, to open an RFC account or current account, you need at least 100 unit of the chosen foreign currency. No interest if the balance is under. For resident foreign currency account FDR, you need 1000 unit to start. Tenure can be 1 month to 3 years. But if you deposit 2.5 lakh dollar or more, you can keep it for as little as 1 week. Non-resident cannot add resident relative at joint holder, but they cannot touch the money while you are alive. They can add, but they cannot touch the money while you are alive. Former or survivor basis, right? So bank staff don't get a special interest rate here. You can even open account with odd amount. No need for nearest round figure. Now the RFCD account is for resident to keep foreign money they send as a gift. They get as a gift, honorarium or leftover travel cash. It is a non-interest current account. We are talking about RFCD account, right? That is called domestic account opening. So basically you do not get any interest. It is a non-interest bearing current account. It has no minimum balance. It has no checkbook, right? Since RFC ROI, right? Since RFC ROI, a special RFC ROI account are there for investment return. They are allowed only in USD, GBP and Euro. If you later become an NRI, you can shift your RFCD account fund to your NRE and FCNR account. Now let's talk about the DDA account, that is called Diamond Dollar account. Let's discuss this key point. So it is a special US dollar current account for gem and jewelry exporter. It does not pay interest, but you can keep 100% of your export earning in it. You can open up to 5 such account, but for that but you can't shift money between them. So for opening the 5 account, there are some eligibility criteria. So basically no minimum balance requirement, I told you, right? And you can also buy foreign currency from the market without touching your DDA balance first. And the best part is there is no minimum balance rule. Now let's look at the acquisition and remittance of the asset approach. And you can open 5 DDA account, but the condition is that exporter must have a turnover of at least 3 average annual turnover of at least 3 crore in the last 5 years. Now if you once lived abroad or inherited property from someone abroad, you can keep it, sell it or invest in it. FEMA allow that. You can also buy property abroad using the liberalized remittance scheme. Indians can get overseas property through inheritance, gift or purchase from another resident who got it legally under the earlier forex rule. So that is what I am telling you. You can buy property abroad using the LRS. Indian can get overseas property through inheritance, gift or purchase from another resident who got it legally under earlier forex rule. If you are NRI, if you are OCI, right? So you can buy house or commercial property in India but not farm, plantation or agriculture land. NRI can receive property as a gift from relative, but again no farmland, plantation or farmhouse. If you inherit property in India, it is valid if the previous owner got it legally. Then we have, when you gifting and non-agriculture property can go to resident, NRI or OCI, but farmland only to resident. All payment for property must go through bank in India and can come from NRE, FCNR or NRO account, not cash, not traveler check or not currency note. And of course you must pay tax and you must pay the tax duty. Now what about the rules for foreigner? Let's have a look. Embassies and diplomat can buy or sell property in India except farm or plantation, but only after getting clearance from the Ministry of External Affairs, and the money must come from abroad. People from certain countries like Pakistan, China, Afghanistan, Sri Lanka, Iraq, Nepal, Bhutan, Macau, Hong Kong, North Korea. Now people with a long-term visa, that is called LTV, right? They issued by the India can buy property under certain rule. And one more point is that minority community from Pakistan, Bangladesh, Afghanistan living in India on LTV, which is called long-term visa, basically can buy only one home for living and one property for running a business, but must follow the FEMA rule. Now friends, if you are married to an NRI or OCI but not one yourself, you can jointly buy one property in India with your spouse. No farm or plantation is allowed, but you will need RBI not to sell money abroad later. So then the next point is NRI and PIO can send money abroad from selling property in India except farm. In FEMA dictionary, translation means pretty much any change in the ownership, selling, gifting, mortgaging, or even pledging a property. Now foreign nation can send up to $1 million a year abroad from eligible asset if they are not from Nepal, Bhutan or PIO category. So you are a foreign nation, you can send up to $1 million a year abroad. All sale money first go into an NRO account in India before being sent abroad. From the NRO account, NRI and PIO can send up to $1 billion. Keep paper. So suppose NRI or PIO earn rent, pension, interest, dividend in India, it can be directly credited to the NRI account after tax are paid. Now let's talk about the marriage linked joint ownership. So what it is all about, that if you are married to an NRI and OCI but not yourself, you can buy one property in India with them. No farmhouse, plantation is required, right? Then the next point is, restriction on repatriation. If you buy under this rule, you or your heirs can't send the sale money abroad without RBI special approval. Remittance by NRI and PIO. So NRI and PIO can send money earned from their selling property in India except farm. Repatriation limit for residential property. For houses, you can send abroad the sale money from only up to 2 property. Right. Then under FEMA, transfer means almost any ownership change, selling, gifting, mortgaging or pledging or even exchanging property. What is the remittance by foreign nation? So you know it very well that that foreigner who are not of Indian origin, right? They can send up to $1 million. Now there is something called Indian resident for foreign firm. If you work for a foreign company office in India, you can keep a foreign currency account, but remember your salary is taxable in India and must be reported. Now foreign nation working in India. If you are a foreigner working in India, you can move your salary into a foreign currency account, but only after paying or setting aside the Indian tax. What are the facility available for NRI? So you can see NRI can have three main types of account in India. First is the NRE account for sending money to India. So NRE account is for sending money to India, as you can see, Indian rupees. NRO account is for maintaining income earned in India like rent and dividend, and FCNRB account is for fixed deposit in the foreign currency. So you qualify as an NRI if you live outside India for at least 120 days in a year and you have spent less than 365 days in India over the last 4 years. Immediate NRI classification: if you leave India for a job abroad, you are treated as an NRI just right away. What about account acronym? You know it very well. What is the full form of all this? Now, what are the facilities available to NRI? Let's have a look. So friends, an NRI can open the NRE account using money earned abroad. It is Indian rupees. The NRO, when you buy foreign currency for import, you can use it for the purpose you mentioned or for any other legal purpose allowed under the Indian law. So whenever you buy foreign currency for import, you can use it for the purpose that you mentioned or for any other legal purpose. Once the good arrive, you must prove that you have actually imported them. This could be through documents like a bill of entry, a postal appraisal form, or a custom assessment certificate. Payment to exporter can be made in a different way. Instead of sending money abroad, you can credit their non-resident account in India. But remember, even then, you must prove import evidence. And finally, you need to make the payment within 6 months of the shipment date. The only exception is if you have held back some amount for reason like performance guarantee. So in short, we can say import freely, follow the paperwork, keep the proof, and don't miss the payment timeline. Right? So I hope this is clear now. Now let's look at the second point, second paragraph. So let's break down some important RBI guideline for import, payment and currency. First of all, if import payment get delayed, maybe due to dispute, money problem or any genuine reason, your bank can still help you settle them. This can include interest or other charges as long as the delay is under 3 years from the shipment date. So if import payment get delayed due to dispute or due to any reason, due to any genuine reason, your bank can still help you settle them. So what bank can do? This can include interest or other charges as long as the delay in under 3 years from the shipment date. Next is, let's talk about the trade credit. You know what is trade credit? This is when you don't pay for import immediately, but you pay for import after some time. For example, if you are importing capital goods like machinery, you can take up to 3 years to pay. Or for other goods, the limit is 1 year or your operating cycle, whichever is shorter, right? So we are talking about the trade credit, right? So basically when you don't pay for import immediately, but you pay for import after some time, that is called trade credit. So for capital goods, like machinery, you can take up to 3 years to pay. For other goods, the limit is 1 year or your operating cycle, whichever is shorter. So what is trade credit? The time, this is when you don't pay for import immediately, but you pay for import after some time. But there is a special case of it. That is the importing books. You can take as much time as you need to make the payment. But if you delay payment or pay within Ujan's bill within 3 years or pay with Ujan's bill within 3 years, interest rate must follow RBI trade credit rule. Right? So I hope it is clear. For trade credit where you don't pay immediately but you pay after certain time. So depending on what kinds of goods you are importing. Capital goods you are importing, 3 years to pay. And for other goods, the limit is 1 year or your operating cycle, whichever is shorter. Bank also have the power to extend your payment timeline. Very, very important thing. You know what I'm talking about? That bank has the power that they can extend your payment timeline 6 months at a time for up to 3 years in total. Right? But you need a valid reason like a dispute over quality, financial trouble or pending court case. So that is the point I'm talking about, that extension of the payment time, which means bank have the power to extend your payment time. At a time 6 months it can be extended or total up to 3 years it can be extended. But for that also valid reason is required like a dispute over the quality, financial trouble or a pending court case. Now currency rule, that if you are an Indian resident returning from abroad except Nepal or Bhutan, you can bring Indian currency note up to 25,000. How much? Up to 25,000 Indian currency note you can bring. From Nepal or Bhutan you can bring any amount, but only in denomination of rupees 100 or less. Last, let's talk about the guarantee. Bank can issue guarantee for import payment or deferred term if RBI approve. They can also give undertaking or comfort letter to foreign supplier, bank or financial institutions as long as it matches the foreign trade policy. So bank guarantee we are talking about. Bank can issue guarantee for import payment on deferred term. Right? So suppose some import payment is due. right? Bank can issue guarantee for those such kind of import payment. Now, but the condition is that RBI should approve it. Bank can also give undertaking or comfort letter to foreign supplier, bank or financial institution as long as it matches the foreign trade policy. So in short, we can say, delays are allowed within the limits. Credit timeline depends on the goods. Right, I told you, trade credit timeline depends on the goods. For capital good, it is 3 months, 3 year, and for other goods, the limit is 1 year. And first point I told you that yes, delayed are allowed within the limit if the RBI feel that the reasons are genuine, then they can allow it. And the third point I told you that book import have some special flexibility, and currency limit vary by country. I told you if you are Indian resident returning from abroad. So like Indian resident, you are returning from abroad, right? So in that case, you can bring Indian currency note up to 25,000 rupees. And then we talked about, bank can back you with guarantee. Yes. So about guarantee, I told you that bank can issue guarantee for import payment on deferred term if RBI approve it. So on import payment with deferred term, bank can issue guarantee, right, if RBI approve. So these are the points which we have made clear. Now let's talk about the next point, next paragraph. Friends, if you are looking for quick notes, quick revision notes on the foreign exchange certification course examination, you can WhatsApp me on this particular number. I will provide you the course link in which I have provided unit-wise theory, unit-wise MCQs, capsule PDF, previous year questions. All these contents will help you to secure good marks in the examination. Right, now let's look at the next slide. Let's talk about some key RBI rule for import payment, guarantee and documentation. In the import payment, guarantee and documentation, so first of all, let's talk about the guarantee for large service import. If an Indian company is importing services from abroad and need a big guarantee of our 5 lakh US dollar, so bank can issue the guarantee on the behalf of the importer, but they must follow RBI specific condition, right? So that is called large service import guarantee. Next point is that import timelines. If you have sent money abroad for goods, those goods must arrive in India within 6 months. For capital goods, the time limit is longer, up to 3 years. And once this period ends, you have 15 days to submit proof that goods were actually imported. Right? Then we have, all the outward payment for import must be reported by the bank in RBI online system, that is called IDPMS. If your payment is delayed, say you are paying through Ujans bill or your payment is overdue, so interest is allowed up to 3 years after shipment, but only at the trade credit rate approved by the RBI. If you want to pay before the due date, that is called prepayment of Ujans bill, right? What is prepayment of Ujans bill? Suppose you want to pay before the due date, you can do that, but you must deduct interest for the unexpired period. So you can pay before the due date, that is called prepayment. You can do that, but you must deduct the interest for the unexpired period. So that is calculated at either the claimed rate or LIBOR rate or another benchmark, whichever apply, right? So basically what I am telling you, that suppose you want to pay before the due date, that is called prepayment. You can do that. So friends, if we talk about the import timeline, suppose you have sent money abroad for goods. So those goods must arrive in India within 6 months. For capital good, I told you the time limit is longer, which is up to 3 years. And once the period ends, you have 15 days to submit proof that the goods were actually imported. And I told you that all the outward payment for import must be reported by the bank in the RBI online system, that is called IDPMS. And suppose your payment got delayed, say you are paying through Ujans bill or your payment is overdue. So interest is allowed up to 3 years after shipment, but only at the trade credit rate approved by the RBI. So what I'm telling you, that suppose your payment get delayed, like if you are paying through Ujans bill or your payment is overdue. So yes, interest is allowed. Interest is allowed up to 3 years after shipment. Interest is allowed, but only at the trade credit rate approved by RBI. Now, if you want to pay before the due date, that is allowed. That is called prepayment of Ujans bill. You can, but you must deduct interest for the unexpired period. That is calculated. So the interest is calculated either at the claimed rate or the LIBOR or another benchmark, whichever apply. Now for documentation, right? Import bill normally should come from the overseas supplier bank to your bank in India. So from where it should come? It should come from the overseas supplier bank to where it should come? It should come to your bank in India, right? Import bill we are talking about. Bank are not supposed to process payment if bill come directly to you, the importer. But there are some exceptions. So what we are talking about, the documentation that import bill normally should come from the overseas supplier bank to your bank in India, right? So suppose there is an overseas supplier bank, let's say Citibank in USA, and there is a bank in India called SBI, right? So import bill is coming from overseas supplier bank to your bank in India. Bank are not supposed to process payment if bill come directly to you, the importer. No. If the bill come directly to the importer, bank will not process the payment. It should come to the bank only. But there are some exceptions in which bank can process the payment. What are the exception? First case is that if it is very small bill, up to $3 lakh, bank can allow that. If it is bill for wholly on Indian subsidy of the foreign company, then bank can allow it. That bank can process the payment, right? And if it is bill for big exporter like status holder, EOU, SEZ unit, PSU and all limited company. And here is a special rule. What is the special rule? For rough diamond, precious and semi-precious stone, bank can allow payment up to $3 lakh even if bill come directly from the foreign supplier. The only condition is that you must show proof of import at the time of payment. Right? For rough diamond, for precious and semi-precious stone, bank can allow payment up to $3 lakh if the bill come directly from the foreign supplier to the importer. Condition is that you must show proof of import at the time of payment. So in short, what we have discussed just now, that you should follow the timeline. Right? What kind of timeline I told you? That for first guarantee for large service import. Right? So big guarantee over $5 lakh, bank can issue it behalf of the importer. Second thing I told you about, route document properly. Yes, document should be routed properly. That import bill normally should come from the overseas supplier bank to your bank in India. That is the normal route, right? Prepayment, yes, you can do the prepayment. That is, you can, but you must deduct the interest rate for the unexpired period, right? And exceptions are there. 3 exceptions I told you that yes, bank can allow process the payment. Condition is that bill up to $3 lakh, bill received by a wholly owned Indian subsidiary, and bill for a status holder export or exporter 100% EOU. Now let's talk about the import documentation and evidence of good receipt. So friends, let's talk about one of the most important part of the import, proving that goods you paid for has actually arrived in India. Right? Suppose the payment you sent abroad is more than $1 lakh. Right? Suppose the payment that you sent abroad is more than $1 lakh. So your bank must make sure that you submit proof. Right? So the payment that you say that you are sending abroad, that is exceed $1 lakh. Right? So your bank must make sure that you submit proof for that. What could be the proof for it? This proof could be the ECC, exchange control copy of the bill of entry for home consumption. The proof could be exchange control copy of the bill of entry for warehousing. The proof could be a custom assessment certificate or a postal appraisal form. That is for goods that come in by post. So what I am telling you, that import documentation and proof of good in simple word. So one of the most important part of the import, that proving that goods you paid for have actually arrived in India. Suppose the payment you sent abroad is more than $1 lakh. Your bank must make sure that you submit proof. The proof could be exchange control copy of the bill of entry. The proof could be exchange control copy of the bill of entry for warehousing. And this apply to the 100% export oriented unit. And a custom assessment certificate or postal appraisal form. This is for good that come in by post. So these are the proof that you have sent abroad the payment more than $1 lakh and goods have arrived in India. For DA basis, DA, document against acceptance, DA transaction, right? So the bank will only make the payment after they get evidence that goods have been imported. That is called documents against acceptance. There are two kinds of things, DA and DP, documents against payment, documents against acceptance. So DA is also called the usance bill. Bank will make payment only if they are sure that they will, basically they get evidence that the goods have been imported. Now there is also a simpler option for certain trusted organization, right? So there are simpler option for certain trusted organization. Instead of submitting the exchange control copy of the bill of entry, they can give a certificate from their CEO or auditor confirming that goods have arrived. Right? So instead of submitting the exchange control copy of the bill of entry, they can give a certificate from their CEO or auditor confirming that the goods have arrived. But there are conditions. What are the conditions? That the payment value must be less than $1 million US. And the importer must be either a listed company in India with a net worth of at least 100 crore, a public sector undertaking or a government of India department, or an autonomous scientific academic institution like IIS, IIT, audited by the CAG of India. So what I am telling you, that there is a simpler option for certain trusted organization. Instead of submitting the exchange control copy of their bill of entry, this kind of organization can give a certificate from their CEO or auditor confirming that goods have arrived. But there are conditions. What are the conditions? Payment value must be less than how much? $1 million US. That means 10 lakh US. And importer must be either a listed company in India,
or a public sector undertaking, or an autonomous scientific or academic institution. In that case only, right, submission of ECC is not required, right? Certificate from CEO is more than enough. So in short, we can say, just to summarize, that for high value import, bank want proper proof. I told you na, for high value import, right, which exceed 1 lakh US dollar, then bank requires proper proof, which could be the exchange control copy of the bill of entry, or for warehousing, or custom acceptance certificate. Then I told you that, but for well established organization, there is a trusted shortcut through CEO or auditor certification, right? These are the points. Now friends, let's switch our focus to the next slide, where we are discussing some special RBI rule around import documentation, non-physical import, and unique trade agreement. First of all, for certain organization like big government or academic body, bank may ask the CEO or the auditor to confirm that their account are audited by the Comptroller and Auditor General or CAG. So for certain organization, right, bank asks the CEO. Next, not all import are physical good. Not all kinds of import are physical goods. Some are digital, like software, data, technical drawing, or design, receive our email or the internet. In these cases, bank don't get a shipping document. So they ask for a chartered accountant certificate confirming that importer actually received the product. Now friends, not all import are physical good. Some kinds of imports are digital, like software, data, technical drawing, or design, receive our email or the internet. In these cases, bank don't get a shipping document, so they ask for a chartered accountant certificate confirming that the importer actually received the product. Now one more point is that if the value of import is more than $1 lakh and the importer does not submit proof within 3 months of payment, the bank will actively follow up for another 3 months, even sending registered letter as reminder. Every 6 months, bank also have to submit a BEF statement to the RBI. This lists all the high value import case where proof has not been submitted for over 6 months. So that is what I am telling you, that half yearly BEF statement. Every 6 months, bank have also to submit a BEF statement which lists all the high value import case where proof has not been submitted for over 6 months. This BEF statement is sent online within 15 days after June and December. So half yearly BEF statement, what it means? So I told you that if the value of import is more than $1 lakh and the importer does not submit proof within 3 months of payment, bank will actively follow up for another 3 months, even sending registered letter as reminder. Every 6 months, bank also have to submit BEF statement to RBI. So this statement, they list all the high value import cases where proof have not been submitted for over 6 months. The report is sent online within 15 days after June and December. On the other hand, for smaller import of $1 lakh or less, bank don't need to chase the importer as long as they are confident the transaction is genuine and the importer is trustworthy. Now some special gold import rule. So nominated bank can import gold on a consignment basis. So nominated bank, they can import gold on consignment basis. A star and premium trading house, that is called STH, PTH, can also import gold on document against payment basis as per their entitlement, and there are no end use restriction, right? So we are talking about some gold import rule, that nominated bank can import gold on a consignment basis. A star and premium trading house, in short we call them STH and PTH, they can also import gold on document against payment, which is called DNP basis. Finally, let's talk about the merchanting trade. That this is when goods are bought from one country and sold to another without entering India's domestic market. So from one country we are purchasing goods and we are solding the goods to another without entering India's domestic market. So to qualify as merchanting trade, the good must not enter India's domestic tariff area. The goods should remain in the same form, no processing or no change. And for Nepal and Bhutan, goods from third country can pass through India under custom transit declaration as per the Treaty of Transit, and in merchanting trade this count as traffic in transit. So in short, basically the rules which we have talked just now, it cover how to prove import. So how to prove import? I told you that not all import are physical goods, some are digital, right? And one for value of import larger than $1 lakh. So in that case, bank will actively follow up for another 3 months, right? So for how to prove import, then how to handle the digital product, right?
So I told you that in some golds, nominated bank can import golds on consignment basis. STH, PTH can also import golds on document against payment basis. And lastly, we talked about merchanting trade, when goods are bought from one country and sold to another country without entering the India's domestic market. That is called merchanting trade, right? So the goods should remain in the same form. These are the conditions. Now, friends, let's switch our focus to the external commercial borrowing. So basically, ECB means when an Indian company borrow money from a foreign lender. So this can be through loan, bond, or other financial instrument. You can think of ECB like taking a loan, but instead of borrowing from an Indian bank, you are borrowing from someone overseas. That is called external commercial borrowing. Means when Indian company borrow money from a foreign lender, right? So why do company do this? Why do company engage in ECB? Basically, they engage in mainly to access large amount of money in the foreign currency. This is especially helpful for big corporate who need fund for long-term project, right? So ECB we are talking about whenever an Indian company borrow money from a foreign lender. This is called external commercial borrowing. So loan, bond, financial instrument, these are the way through which ECB can be done. Means Indian company borrow money, either loan or the bonds or financial instrument, right? So company goes into ECB to access large amount of money in the foreign currency. So they have to access large amount of money in the foreign currency. That's why they go into external commercial borrowing. There are two types of ECB. One is called rupee denominated ECB, which means you borrow in rupee and repay in rupee. Another is called foreign currency dominated ECB. You borrow and repay in that foreign currency like dollar or euro. That's the difference. Rupee denominated means you borrow in rupee and repay in rupee. Foreign currency denominated means you borrow and repay in that foreign currency like dollar or euro. The RBI keeps an eye on this. They decide how much you can borrow, what you can use it for, other compliance rule they decide. ECB is usually taken for long-term needs and large sum, like building a new plant, improving expensive machinery. A big advantage is the cost. If the loan come from a country where interest rates are lower, it can work out cheaper than borrowing in India, right? So that's why I told you that it is for long-term and large sum. Like suppose you want to build a new plant, or suppose you want to import expensive machinery. So what is the cost is the big advantage. Suppose loan come from a country where interest rates are lower, it can work out cheaper than borrowing in India. Now, when foreign currency is needed, for example, suppose to buy capital good from abroad, you want to buy capital good from abroad. For that, you need foreign currency. So ECB can be a perfect fit. There are two ways to raise ECB: automatic route, approval route. Automatic route means if you meet RBI rule, you don't need prior approval. That is called automatic route. Approval route means for certain sector or cases, you must get permission from RBI or the government before borrowing, right? So there are two kinds of route: automatic and approval. Approval means for certain sector or cases, you must get permission from RBI or the government before borrowing. So in short, we can say ECB is a way for Indian company to borrow big, often cheap from overseas lender, but always under RBI watch. Some more points about ECB let's talk about. So ECB usually comes with a minimum maturity of 3 years. That means you can't just borrow and repay in a few months. They are meant for medium to long term funding. Second point is that it is not just the RBI that monitor ECB. The Department of Economic Affairs, or we call it DEA, in the Ministry of Finance, they work together with the RBI to make sure that all the rules are being followed. And third point, so basically what is the conclusion is that ECB are long-term borrowing, closely monitored by both RBI and the Ministry of Finance, and most of them are linked to the US dollar. Now let's talk about the export of goods and services, right? So basically the main authority in charge of the export trade is the Directorate General of the Foreign Trade, or we call it DGFT, under the Department of Commerce. So DGFT is under the Department of Commerce is the regulatory authority, right? So bank, they are also called authorized dealer or AD bank. They can give guarantee for their export client in overseas trade. So bank, they are also called authorized dealer or AD bank. They can give guarantee for their export client in overseas trade, but only if they follow RBI prescribed condition, right? So bank give guarantee for what? For their export client, right? So bank have some export client in overseas trade, so bank can give guarantee. So when it comes to contract and payment, when it comes to contract and payment, your export contract or invoice can be in any freely convertible currency like dollar, euro, yen, or even in Indian rupees. But here is the important part: the payment you receive must be in a freely convertible foreign currency, right? So when it comes to contract and payment, your export contract or invoice can be in any freely convertible currency, right? But
One important part is that the payment you receive must be in the freely convertible foreign currency, right? Now about the free of cost export. Sometimes exporters send good abroad for promotion without charging money. In such case, bank can waive the requirement for filling the EDF. What is EDF? Export declaration form. But only they can waive up to 2% of your average annual export in the last 3 years, or rupees 5 lakh, whichever is lower. So what is free of cost export? So sometimes exporters send good abroad for promotion without charging money. In such case, bank can waive the requirement for filling the export declaration form, but only up to 2% of your average annual export in the last 3 years, or 5 lakh, whichever is lower. For a status holder exporter, big exporter recognized by the government, the limit is higher. That is rupees 10 lakh, or 2% of the average annual realization in the last 3 licensing year, whichever is higher. Now, if you export without receiving any foreign exchange inflow at all, so you have exported but you have not received any foreign exchange inflow, so in that case you need a special EDF waiver from the RBI. For trade related purpose, the financial year is always counted from April to March. You know it very well. Now you might also hear the term something called OPGSP, that means Online Payment Gateway Service Provider, which is used for collecting export payment online, right? So for collecting the export payment online, this OPGSP system is used. And here is the useful rule, that if you are setting up an office overseas, your bank can allow you to send money for initial expense up to 15% of your average annual turnover in the last 2 years. So suppose if you are setting up an office overseas, right, means outside India, so your bank can allow you to send money for initial expense, which can be up to 15% of your average annual turnover in the last 2 years, or 25% of your net worth, whichever is higher. So they will look at your net worth, they will also look at your average annual turnover. For average annual turnover, they will take 15%, and for your net worth, they will look at 25, they will take 25%, right? And whichever is higher, that much financing bank can provide you for setting up an office overseas. So in short, we can summarize is that the DGFT, I told you, Directorate General of Foreign Trade, they set the rule, right? Main authority is in charge of the DGFT. Then we talked about payment must be in the foreign currency. I told you that when it comes to contract and payment, right? So your export contract or invoice can be in any freely convertible currency. But about the free of cost export, bank can waive the requirement for filling the EDF, I told you. Then we talked about, there is a special waiver for promotional export, which we have just discussed now, right? A special waiver is given. And also there is a cap on how much you can send abroad for starting an overseas office. So what is the cap? 15% of your turnover or 25% of your net worth, whichever is higher. That is the cap. Now friends, let's look at the export of the goods and services, some more key points. So let's go over some more important RBI rule for exporting goods and services. So if you already have an office or branch abroad, you can send money for its regular running cost. Things like rent, salary, utilities. What is the limit? 10% of your average annual turnover in the last 2 years, and there are certain conditions that you must follow. So that is called recurring office expense abroad. So if you have an office or branch abroad, you can send money for its regular running cost. Now exporter with at least 3 years of good track record can take long-term export advance, right? Basically advance payment from buyer for up to 10 years if it is for fulfilling long-term supply contract. So those exporters who having 3 years of good track record, they can take long-term export. You can see they can take long-term export advance. Basically advance from the buyer for up to 10 years. That is called long-term. Why? To fulfill long-term supply contract. Some goods take a long time to make, more than a year, like a specialized machinery. In such case, your bank can allow you to take advance payment if the export agreement clearly says so. Again, under the specific condition. So that is the point. Now if you are participating in a trade fair abroad, right? Suppose you are participating in a trade fair abroad, you can take goods there for display and sale without needing RBI prior approval. But if some goods remain unsold and you bring them back, you must submit the bill of entry within 1 month of re-import. So suppose you are participating in a trade fair abroad, you can take goods there for display and sale without needing RBI prior approval. But if some goods remain unsold and you bring them back, you must submit the bill of entry within 1 month of re-import. Remember this key point. Now, what if you send good abroad for testing and they get destroyed? In that case, you don't need a bill of entry. Your bank can accept a destruction certificate from the testing agency instead. Now there is something called a special notified zone, that is a custom designated area for a specific type of trade activity. There is something called DTA, or we call it domestic tariff area. It is simply the part of India where normal custom duty apply. It excludes places like a special economic zone. Lastly, if you are exporting machine or equipment on a lease or hire basis, you need prior RBI approval. So the agreement ensured that you collect lease rental or hire charges and plan to bring the goods back later. So in short, we can say that these rules cover overseas office expense, right? So they cover the overseas office expense. I told you the limit is 10% of your average annual turnover in the last 2 years, right? And basically long-term advances are also covered. So I told you exporter who are having at least 3 years of good track record, they can take long-term advance. Then also we talked about the slow to produce export. So what is the meaning of slow to produce export? Some goods take long time to make, like a specialized machinery. So your bank can allow you to take advance payment if the export agreement clearly says so. That is called slow to produce export. Trade fair we talked about, that if you are participating in a trade fair abroad, you can take goods for display and sale without needing RBI approval. Then we talk about destroyed goods, right? So suppose you send good abroad for testing and they get destroyed, then you need bill of entry, right? Then we talked about special custom zones. So there is something called special custom zone. This is a custom designated area for a specific type of trade activity. Then we talk about the domestic tariff area. So this is simply the part of India where normal custom duty apply. Now in the next slide we talk about the export process, project export and currency regulation. Let's break down some important point about export process. First of all comes the dispatch of export document. So if you are a status holder exporter or SHE, or you work in a SEZ unit, your bank called the AD bank can allow you to send export document directly to the foreign buyer. So if you are a status holder exporter, your bank can allow you to send export document directly to the foreign buyer, right? But there is a condition. What is the condition? That you must send the duplicate EDF copy to your bank within 21 days of the shipment, so that they can track it. So basically what we are talking about, the dispatch of export document. So your bank can allow you to send documents to your foreign buyer, but you must send a duplicate copy, that is called EDF copy, to your bank within 21 days. Second is the direct dispatch by bank. Sometimes the bank itself can send you shipping document straight to the foreign customer or their agent. This is allowed. So that is called bank also do the direct dispatch. This is allowed if you have received full payment in advance, or there is an irrevocable letter of credit that fully covers the shipment value, and your sales contract or LC clearly allow the direct dispatch. Third, there is something called export on extended credit. If you are selling goods but giving a very long time for payment, say more than a year, say more than usual, so you can't just decide on your own. You have to submit a proper proposal through your bank, and the RBI regional office must approve it. So that is called export on extended credit. Suppose you are selling some product and you are allowing the timeline for payment more than the usual timeline. So in that case, you have to submit a proper proposal through your bank, and the RBI regional office must approve it. Finally, we have something called project export. This simply means exporting engineering goods and services where payments are delayed, like turnkey project, big construction work abroad, or infrastructure building outside India. And finally, there is something called currency rules for traveler. Suppose you are Indian resident, so you can carry up to 25,000 rupees in Indian currency notes when traveling abroad, but not to Nepal and Bhutan. And yes, if you are a foreign visitor living India, you can also take up to 25,000 rupees in Indian notes, but only through an airport, with some restriction for traveler from Pakistan and Bangladesh. So in short, what we have talked about is that export document handling has a strict timeline and condition, right? 21 days. I told you that you have to submit the you can send to the document to the foreign country importer or buyer, but you have to submit the EDF form and duplicate form to your bank within 21 days. Second point we talked about is that project export involving big contract. I told you that like turnkey project, big construction project, right? So they are also included under it. Then we discussed, that currency limit apply, $25,000 rupees. Remember, if you are Indian resident, you can take 25,000 rupees in Indian currency note, right? If you are foreign visitor, you can also take 25,000 rupees in Indian note. This is the limit. Please remember it. Now in the next slide, we talk about the export documentation. Friend, if you really think that this video is helping you to understand your concept, please hit that like button. This will encourage me to make more such and such content.
Now friends, let's talk about some very important rule for export documentation and reporting. Basically, what exporter and bank have to do to keep RBI happy and avoid trouble. First of all, whenever export documents are sent to the buyer bank, whether for immediate payment or for collection letter, your bank called the AD bank must report the detail to RBI through something called the EDPMS system. So your bank, which is the exporting bank, right? Suppose they want they whenever export document are sent, they send the export document to your buyer bank. So what your bank will do? Your bank will send a report through RBI to the RBI through the EDPMS system. Think of it like a RBI master record for all import. Second, if you are sending goods by post, so you can't just pack and send them like normal parcel. You need a special form that is called EDF form. We have been discussing about this EDF form since the beginning, right? So you have to fill this form, EDF form, and it has to be countersigned by your bank before the goods are shipped. Third, sometimes exporters submit document late after 21 days of shipment. The good news is that your bank can still process them without RBI special permission as long as they are happy with your reason for the delay. Fourth point is that there is something called late submission of export document. I told you, duplicate EDF form and shipping paper. So you are once you give the bank your shipping paper or EDF form for payment, you normally can't give them back unless you need to make correction and resubmit. So once you give the bank your shipping paper or once you give the bank your EDF form for payment, you normally can't get those shipping paper and EDF form back unless you need to make correction and resubmit. Next point is that for landlocked country, sometimes the bank can give one negotiable bill of lading to the ship captain or trade representative. Right? For landlocked country, the bank can give one negotiable bill of lading to the ship captain or trade representative, but only if it is under an irrevocable letter of credit and all the LC conditions are met. Right? So this is a very important part. Then, so sixth point is that exporter can pay commission to agent abroad. Right? Exporter can pay commission to an agent abroad either by sending money directly or by deducting it from the invoice, but you must apply to your bank for approval. Right? So that is called sending commission. Basically what I'm talking about, that exporter can pay commission to the agent abroad either by sending money or by deducting it from the invoice. Suppose if you have to re-import goods, right? Suppose you have to re-import your goods because they were defective or of poor quality. The same bank that received the payment can allow a refund to the buyer, right? Now, and finally, exporter must always mention their IEC code. You know what is IEC code? Importer Exporter Code from DGFT. The DGFT issue this code. So exporter must always mention this IEC code on all the declaration form and communication with the bank or RBI. That is your export ID card. So in short, you should keep your bank informed, right? So basically, your export document you can send to the buyer bank, but you must report the detail to the RBI. Bank must report the detail to RBI through EDPMS system. Second point I told you, if you are sending via post, then bank must countersign it, and then EDF form has to be filled, and then you can parcel it. And then after I told you that if the exporter submit the document late, right, like after 21 days from shipment, in that case it is extendable, but you have to provide the proper reasoning. Then I told you that basically follow the RBI rules. Landlocked country, bank can give a negotiable bill of lading, right? Then we talked about exporter can give commission to the agent abroad, and if you want to re-import the goods, yes, the same bank can receive an IEC code we have talked about. In the next slide, let's talk about export declaration and realization timeline. Whenever an exporter sends goods outside India, they have to declare it officially. This is done through something called EDF form, export declaration form. You give this form in duplicate to the custom commissioner. Custom will check and approve it. Then the original copy goes to the nearest RBI office and the duplicate come back to you so that you can give it to your authorized dealer bank, basically your AD bank. So duplicate copy is there, custom copy send one copy to the RBI and one copy is returned back to you. Now, if you are exporting software, audio, video, TV content, you won't use EDF. Instead, you will use soft text form. This form is given in triplicate, meaning 3 copy, to a designated officer at a place like STPI, FTZ or SEZ. All 3 copy are stamped and signed, and then the original goes to RBI, 1 copy come back to you, and 1 stays with the officer. Once you receive the payment from your foreign buyer, your ready bank will keep those duplicate EDF or soft text form for their record, right? And here is the important deadline. Normally, export payment must be received and brought back to India within 9 months from the date of export, whether you are SEZ, EOU, STP, ESTP or BTP. But you have sent good to an overseas warehouse, you get a little more time, which is a 15 months from the shipment. So in short, fill the right form, submit it to the right place, and make sure your payment come in time. These are the very important thing. So we have discussed in detail in our course. In our course, you will get unit-wise videos, explanation of each and every content in the lucid manner, so that you have conceptual clarity, right? You can get all this in our course. You can check the course in the description section. Now let's talk about the submission of the export document. So I told you that timeline I think we have discussed. So whenever you export good or even software and media, you have to declare it officially using EDF or Softex form. Timeline I told you, once you have exported the goods, there is a 21-day timeline, so that you can submit this document to your bank, but not just any bank. It has to be the authorized dealer bank, right? So you remember, for software and media export, the 21 days are counted from the date your Softex form is certified. Think of it as this: you ship your good, clock start ticking, 21 days to submit paper to your bank, right? Then we have the something called ODI. What is ODI? ODI is the overseas direct investment. Yes. So before that, let's talk about ACU country. So basically what is ACU? That trade with Sri Lanka from 8 July 2022. All eligible current account transactions, including trade with Sri Lanka, can be settled in any permitted currency outside the ACU framework under further notice, right? So remember, these are the guidelines. Now let's talk about the ODI. So ever heard of the Indian company going global? That is called outward direct investment, and it is exactly how Indian brand set foot in the international market. So outward direct investment, or ODI, simply means when Indian company invests money in another country to start or expand its business there. You can think of it like this: if an Indian company open a factory, office, or buy a big share in the company abroad, that is called ODI. Or we can call it outward foreign direct investment or direct investment abroad. How it is different from FDI? FDI is a foreign company comes and invest in India. ODI is an Indian company goes and invest abroad. So usually ODI happen in two ways. The first way is called wholly owned subsidiary, right? The Indian company fully own the overseas business, that is called wholly owned subsidiary. Second case is the joint venture, which means Indian company partner with a foreign company to run the business together. So ODI happen in two ways: WOS or joint venture. Why do companies do this ODI? Because to expand their brand and to grab new customer in the other country, right? So how they can invest? They can invest through automatic route or through approval route. Automatic route means no government or RBI approval is needed if it follow the state rule. And approval route means a special permission is needed when it does not fit in the automatic route norms. Now ODI means Indian money plus foreign business. It help company grow global, right? So WOS is one way through which ODI happen, or joint venture is another way. Now let's talk about the offshore investment, offshore investing. So that basically what is the meaning of offshore investing? Let's discuss this point. So overseas investment by Indian citizens are governed by the Indian Foreign Exchange Control Regulation. So basically it enables global diversification, access to the international market, leading business. Let's talk something about FDI, FTP. So FDI basically means when someone from one country invests their money into a business in another country. But the FDI can happen in different way. Foreign direct investment, equity capital, right? So you can do the FDI. You can classify the FDI by the nature of the investment. Either it can be equity capital, which means this is the simplest way. You directly buy the share, right? You directly buy the share in a company abroad, just like buying share in India, but here you are buying in a foreign company. That is called equity capital. Second is the reinvested earning. What is the meaning of reinvested earning? Which means that suppose you already have a business in another country and it make profit. So instead of bringing the profit back home, you put it back into the foreign business to help it grow. And finally, we have intra-company loan. So what is the meaning of intra-company loan? This is like lending or borrowing money between a parent company and its branch in the other country. What are the types of FDI? I told you vertical FDI, horizontal FDI, conglomerate FDI, platform FDI. These are the different types of FDI. So here you can see types of FDI by nature. I told you. What is the meaning of horizontal FDI? Means you start the same type of business in another country. For example, an Indian clothing brand opening a store in the US. What is vertical FDI? Here you invest in different stages of your supply chain abroad. Like a car company from India setting up a tire manufacturing unit in the Thailand. Means you invest in a different stages of your supply chain abroad. Different stages of your supply chain, right? So you are setting a tire manufacturing unit in Thailand, right? Then we have conglomerate FDI. So you invest in a totally unrelated business. For example, Indian IT company buying a food processing factory in Europe. And finally, we have the platform FDI, which means you set up operation in one country, but the goods and services are made mainly to export to a third country. Mainly companies do this in low cost or free trade zone. Finally, if you look at the routes for FDI into India, it is automatic route, which means easy entry, no prior permission needed from RBI or the government. Government route, which means you must get approval first through the Foreign Investment Facilitation Portal. Then we have something automatic plus government route. In some cases, part of the investment is automatic, but certain approval are still required. So in short, FDI can be of different types depending on how you invest, what business you invest in, and which route can you take to enter a country. Now, basically if we compare FDI and FII, so let's clear the confusion between FDI, FII and FPI. These three terms that sound similar but mean very different. You can think of FDI like planting a tree in someone else's garden, but you also take care of it. Here an investor from one country put money directly into a specific business in another country. They usually take a controlling stake, bringing technology, research, skill, even business strategy. For example, a global car company setting up its own manufacturing plant in India. That is FDI. FII is different. Here the big institution like a mutual fund or pension fund invest in the financial market of another country. They don't run the business, they just buy share or bonds and hope that value goes up. And it is money only, no control. While in FDI there is a controlling stake. While FPI is called foreign portfolio investment, what happened here is like FII cousin. It is when investor, foreign individual, fund or institution, they buy financial asset like stock, bond, mutual fund or even fixed deposit in another country. But again, this is a kind of passive investment. So if we see the categories of FPI, right? So there you can see there are the first category is government. Basically as per CB, there are three categories of FPI. Category 1 is government, central bank and big international bodies. Category 2 is regulated institution like mutual fund, insurance company, bank, portfolio manager, etc. And category 3 is other like NGO, trust, foundation and even individual. Now who regulate this? In India, CB is the main regulator under the Foreign Portfolio Investor Regulation 2019. FPI must also follow FEMA and the Income Tax Act. So suppose if you are an entity that is not regulated, you can still register as category number 3 FPI, but you don't apply directly to the SEBI. You go through the DDP. What is DDP? Designated Depository Participant. So what I'm talking about, suppose you are an entity that is not regulated, so you can still enter FPI, category 3 FPI, but you don't apply directly to the SEBI, you go through DDP. So in short, we can say FDI is a long-term controlling investment. FII or FPI, they are short-term market focus, no control. Right? Now, some more points about FPI given in your syllabus. Let me discuss that also. So let's break down some important rule about the FPI. Any single foreign portfolio investor cannot hold more than 10% of the company total share. This keep control in local hand and avoid one foreign investor taking over. An FPI can have only one depository account for all of its investment. Think of it like a single locker for all your share. FPI can place order directly with the broker. No middleman is required. Right? Eligible investor include NRI and overseas organization. So remember, FDI is just like hands-on investment in a business with ownership and control. And FII is the money puts into financial market but no operational control. Now friends, about the foreign companies setting up in India, there are three main types of offices they can open: branch office, liaison office and project office. What is branch office? Branch office is opened to carry out business activity like manufacturing or services. Liaison office is opened which is like a communication bridge but no actual business transaction. And project office is set up for a specific project in India. RBI approval is needed before a foreign entity can open a BO, LO or PO. Right? So remember, approval is required. Then BO in SEZ. Foreign company can open branch office in a special economic zone for manufacturing or services under certain condition. What is the bank account for BO? For credit means money in, fund from the head office and legitimate operational earning. What about the debit, which means money out, local expense, profit repatriation, closing down payment. What about the bank account for PO? Most foreign company can open one without prior RBI approval if they have a government or PSU awarded project. Right? Suppose what I'm talking about, most foreign company can open one PO. So basically, these BO, PO, LO, these are the different type of offices that foreign company can set up in India. Branch office, liaison office, project office, right? So bank account for BO, it can be for credit, means money coming in, debit, money going out.
Now, if we talk about the bank account for PO, most foreign company can open one project office account without prior RBI approval if they have a government or PSU awarded project.